Paul Sweeney
on Bloomberg Radio.
I don't know. I'm trying to educate John Tucker on the merits of soccer/football.
You like a game where you can end in a 0-0 tie.
Oh,
that's not a game. That's
so
I don't know what it is.
All right, so the billions of people around the world are obviously wrong. All right, coming up in this hour, we're going to get the latest on the markets with Jess Menton. She's here in studio. It's Friday. That means we talk municipal bonds with Joe Mysak. Poor Matt Miller. Gonna miss it. That's a shame right there. And we're gonna check in with Quincy Crosby. She is the chief global strategist at LPL Financial. What is she telling her clients on these markets? We'll get to all that this hour. But first, let's kick it all off with Mr. John Tucker in Bloomberg Business Friday.
All right, Paul and Simone. Stocks are higher right now. Yields are lower. Investors weighing the payrolls figures that showed a cooling but still pretty much robust jobs market. So that is leading lower yields. The 2-year 6 basis points lower, 482 right now. Stock averages are higher. Markets also assessing earnings from tech giants Apple and Amazon. And analyst Tom Forte at D.A. Davidson weighing in on the Apple earnings.
So the most concerning statistic from Tim Cook on the call yesterday was that consumers, more than half, are already paying for their Apple product on an installment basis. So I think the low-hanging fruit's been picked.
And then Amazon's quarterly profit, that trounced market expectations boosted by strong sales. Amazon shares 11% higher. And Fed speak, the Fed Bank of Atlanta President Raphael Bostic saying U.S. employment gains slowing in an orderly manner. There's no need to hike rates further to ease inflation, he says. And then you heard right here on Bloomberg Radio and Bloomberg YouTube that Austin Goolsbee sounding dovish. The Fed president from Chicago telling it, Bloomberg, we've been getting promising numbers on inflation. S&P 500 up 23 points. That's a rise of 0.5% at 45.24. The Dow Jones Industrial Average up 179 points. The NASDAQ 100, 95 points higher. That is up 0.6%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Simone and Paul.
All right, John Tucker, thank you very much. We appreciate that. Simone Foxman, Paul Sweeney here in our Bloomberg Interactive Broker Studio. And we are streaming live on YouTube. You can head over there and just search Bloomberg Global News, and that'll take you to the live stream. Good day in the markets. S&P up 0.5%. Let's bring in Jess Menton. She covers all the markets for Bloomberg News. She joins us here in our Bloomberg Interactive Broker Studio. Jess, what are you looking at today?
Paul, I'm surprised that you're here on a summer Friday.
I know.
But is it because it's cloudy? You can't go to the beach?
There's a certain person out there you can blame. I put in for it, but for some reason they're not honoring my request.
Maybe next Friday.
Maybe, yeah.
Actually, I think you are off next Friday because I think I'm back.
We got to get that in before summer's over. I get
Exactly.
it. Looking at a weekly basis, though, for the S&P 500, down a little more than 1%. So on pace for its worst week since late June. Earlier, though, coming into today, it was on pace for its biggest weekly decline since March, actually, but has come off of that. But this basically looks like it would still hold these weekly losses, so snapping 3 consecutive weeks of gains there. But overall, if you're looking still on a yearly basis, S&P 500 up double digits, up still close to 18%, and within about 6% of its record high on January 3rd of 2022. So when you are looking underneath the hood here, though, for the S&P 500, obviously Apple, which has the biggest weighting in the S&P 500, ticker symbol AAPL, that is what's kind of keeping those gains in check. So that stock's down about 3% this morning, on pace for its worst day since January 3rd of earlier this year. Obviously, we did get earnings results from the iPhone maker after the closing bell yesterday, so we know as far as what happened with some of the metrics there that disappointed some investors. But more broadly, though, if you're looking at the S&P 500 this earnings season, more than 70% of companies have actually reported so far, and those earnings are actually supposed to decline around 8% year over year, and the preseason estimates were coming in at around 9%, but energy has skewed some of those estimates. So when you do take that out, the earnings outlook does look a little bit brighter. But what's interesting is the profit beats have been getting basically a tepid welcome. So if you look at a company on average right now in the S&P 500 that's reported earnings, they've beat the S&P on average in excess of about 1%, but that's actually below the 6-year average. That 6-year average is around 1.3%. But the beats are getting, the misses rather, when you're looking at EPS as well as sales, those are getting punished, losing on average around 1.7%. Some of the biggest companies, though, as far as when you're looking at who's reported so far, those that have had the most upside price returns were actually Arista and then also Align Technology, where as those, if you want to see who's been punished the most, it was actually DXC Technology and Generac Holdings, which reported results earlier this week. And then if you want to eyeball what's happening in some of the transcripts this earnings season. So not surprisingly, we've talked a lot about how the AI chatter has surged a lot. But when it comes to inflation mentions as well as recession on these calls, seems to have peaked out. So
Really?
not getting mentioned as much when you're looking at what corporate America is looking ahead to. So seems like inflation. And then also something that surged is inventory destocking. Is the
inventory destocking. Okay, so we're
Right.
drawing down our inventory.
Exactly.
Okay.
So that's coming in behind that. And Laura Calvasina over at RBC Capital Markets was sort of crunching the numbers there using the Bloomberg terminal for when you are looking at those mentions.
It's interesting too because inventory destocking is something that really affects retail.
It
They had
does.
built up a bunch of stock, but I was looking into the earnings of Solar Edge and Generac and a lot of these energy companies that have homes have actually seen inventory increase because people are not extending or banks. It's harder to get credit, and so therefore
Right.
people are not borrowing a lot, and then therefore they don't put their money into expensive home upgrades. It's very interesting dynamic here.
Is this point in the earnings season too? I know a lot of people like to say, "Hey, it's winding down and we're almost over," but we still have a huge amount of retailers that are going to report in the next few weeks. Beyond that, obviously, we have Disney next week, but after that, the following week, August 17th, that's when we're supposed to hear from Walmart. So that's going to be key in the next few weeks, even beyond next week, as far as what Walmart's talking about the consumer. We still have to hear from Target, Macy's, Nordstrom, obviously some of the more dollar stores like Dollar General, Dollar Tree. So we aren't actually completely done just yet. But when you are looking at some of these markups for the earnings projections, looking a year out, they are actually starting to improve. So the earnings revision momentum from Bloomberg Intelligence, Paul, which Gina's Martin Adams team looks at a lot, it's actually the highest it's been since May. And that's really telling you that analysts are starting to mark up those expectations. And really? They're geared toward, if you're looking at industrials and discretionary, and then tech right behind that are starting to get the most markups, whereas the ones that are falling behind that are negative, it's actually energy and more of those kind of value corners, which makes sense. That was the sector that was obviously kind of leading the outlook last year that skewed what was happening with the weakness in other sectors, whereas the flip side of that is happening this year.
Yeah, just looking at the EA function, and you put that in for the S&P 500, and it's almost slow to load because it's got like a gajillion databases. So I'll have to talk to Tom on the 6th floor and see what's going on there. But 420 out of the 498 companies in the S&P 500 have already reported. Sales growth about flat, earnings growth negative 8%. And I know Gina Martin Adams at Bloomberg Intelligence scrubs up that earnings number, and she gets a cleaner number. But still, third quarter in a row of negative earnings growth. So an earnings recession, as Gina has called it. It's there, but we're troughing here, I guess, from Gina's analysis, and she thinks earnings growth picks up.
Right,
again.
and so right now it's a little over 7% contraction with the latest amount of companies that have reported, more than around 83% of the market cap for the S&P 500. But when she talks a lot about is when you exclude energy from those estimates, back to return to growth in the second half of this year.
And interesting here, consumer discretionary, 40 of 52 companies have reported in the S&P. Sales surprise, 3.9%. Earnings surprise, 25%. Wow. And also seeing some growth. And I think it's interesting to put that in the context as well as Amazon's earnings, which were pretty strong on, consumer behavior online.
And especially the consumer, the worst of the profit pain was actually supposed to be, when you're looking at consensus on Wall Street, would have been in this last quarter for the second quarter. So it's starting to be bode a bit better for especially these more consumer-oriented companies, but still they are struggling when it comes to the wage picture. And it's a little bit divergence if you're looking at like a Campbell's Soup or, say, General Mills versus like a Coca-Cola or a Pepsi, who have been able to pass on those costs more easily.
All right, I'm just in a context, just for Matt Miller, Nikola, the the electric truck maker. They had some disappointing numbers today. The stock's down. They also named Steve Gursky. He was on their board, as chairman of the board, as their CEO, as their existing CEO stepped down. little fun fact, I worked with Steve Gursky
Really?
way back in the day at
Way back
Payne Weber
when?
in the mid-'80s. I was a research assistant to the railroad and trucking analyst. He was the research assistant to the auto analyst at Payne Weber, and we sat next to each other. And now look at him. He was actually ran a big advisor to General Motors during the great financial crisis when they had their problems there. So one of the leading people in the auto industry, is super smart dude, so maybe he can have some good effect there on the folks at Nikola. So we'll note that as well. All right, Jess Menton, thanks so much for joining us. Jess Menton, she covers all of the markets for Bloomberg. We appreciate getting a few minutes of her time. It is Friday, so the focus on munis is brought to you by Build America Mutual. The new deal created American infrastructure that unleashed new opportunity. Today, we're doing it again with a massive investment in modernizing our infrastructure and municipal bonds backed by Build America Mutual. Help make it happen. Invest in the future of America with BAM.
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 Bonds.
Bam.
There we go. We tried. All three of us can't do it as well as Matt, but we'll get Matt back in next week. He loves municipal bonds. Joe, thanks so much for joining us here. You know, the bond sell-off, it's not sparing your municipal bonds, is it?
Oh, what a week. What a week. I think we are, yields are up about 20 to 30 basis points, kind of across the board. It has been I don't know, what could you call it, depressing week?
Right.
You know, we're getting good economic news, supplies picking up, but wow, the market got a beating.
Well, how much do you think that this was on the back of this Fitch cut to the U.S.'s AAA rating? Was that at all part of the story?
Yeah, you know, that's a little bit of it. I mean, that seemed to have kicked things off, didn't it? Otherwise munis were, munis are a lagging indicator. They're always behind the curve, and here's treasuries going wild, and all of a sudden munis will snap in. Today, for example, munis are about unchanged. So, I checked 10 minutes ago. So,
Joe, you had one of my favorite articles of the day, and it kind of got to it's very important for this studio here because we all know John Tucker. He winters down in Palm Beach, and he summers up in Bar Harbor, Maine. And you have a story, Joe. Bar Harbor's. They're going to the bond market. What do they need money for?
By the way, it's Bahaba.
Bahaba. What do they need money for?
well, they're doing a little refunding, a little capital improvements, fixing up the streets, and it's nice. I hadn't checked out Bar Harbor in quite some time, and I was kind of impressed with it didn't really have the Hamptons feel, it had the North Shore feel, actually. And how'd they do? They did, they did very well because they came a little earlier in the week. East Hampton also came this week.
Yeah, is there some common thread that, fancy summer...
All these shore towns.
All the shore towns.
Nah, it's just, every once in a while you'll see one of these very wealthy issuers step in, and it just so happened this week that we saw two of them. And, if you, on the East Hamptons, you got almost 260 on the bonds due in 2034. And I see that you got about 290 on the bonds for Bar Harbor.
Nice. Well, I noticed from your reporting and that of your colleagues on the municipal front, for some of these kind of resort towns, what they found in the pandemic is people are coming out there more year round, and they're not just looking at it as a kind of a summer place. So as a result, they need more resources. So,
right, and you do need to fix the roads because there's more traffic on them.
And they got to build ball fields out in the Hamptons for the kids because there's more kids playing Little League because they're out there all year round. So that kind of made some sense to me. But
yeah.
I was just happy that, our good friends in Bar Harbor and the Hamptons are getting, the money that they need.
Also, perhaps capitalizing on some of the summer enthusiasm. People feel excited to go to some of these places. Maybe that's the right time.
So talk to us about the private placement of municipal bonds. I forgot this because I didn't even know that this was a gig anymore. There is a market for the private placement of municipal bonds, right?
Oh man, they've exploded. They have. Nick Curlo did a story for us this week. They have grown to 8% of total long-term issuance, up from less than 1% in 2008. And that's because we're seeing a lot more crazy deals, crazy, lunatic deals. A lot of these deals that are offered in minimum denominations of $100,000, usually unrated, often for project finance. And a lot of these guys will just take the private placement route and just, line up 5 or 10 investors and sell it that way.
I mean, yeah, there's a good quote in here. The corporate market is very developed private placement or private debt markets. We've heard about that, the private credit market. Municipal bond market is just starting to get there. So that kind of makes sense because we've seen a huge growth, as I know you're well aware, Joe, just of the private credit business. We all know about private equity, but private credit has been an incredible growth story since the end of the great financial crisis when the banks pulled back their lending,
right,
and borrowers were going to the private market.
But is this the banks pulling back, or is this just wacky deals that they would never have funded?
No, from what from what I've learned talking to these people, it really is just a supply and demand. And when the banks pulled back in the supply of some of the credits, particularly riskier credits, that they didn't want to hold on their balance sheets because of the regulatory hit, the private market kind of developed. And so you've seen investors pour tons of money into private equity as part of their alternatives investments. Man, it's been, so I always tell people, if I could come back onto Wall Street today, I might look at private credit as a career path because that seems to be where the money's going.
Now, the funny thing is, the last couple of weeks, what we've seen here is some investors kind of reconsidering risk because the deals that are on the calendar that are a lot of very risky speculative project finance deals, we've seen those go day to day.
Yep.
So it's a little harder to sell those. They've got to try a little harder and maybe give a little more to get those off. In other words, to destock inventory.
And there actually might be
destocking.
Some covenants on some of these now, I understand.
Oh, yeah.
So
right.
The covenant light deals, those things are done. Covey light, we used to call them. Can't get that done anymore. Guess what, Joe?
No, that's it.
That's it.
That's it.
That's it for Munis this week. Joe Mysak, editor, Bloomberg Briefs, covers all the municipal markets, and we appreciate that for Bloomberg News. He comes in every Friday, Bloomberg Interactive Broker Studio. No mailing it in from Brooklyn for Joe, and we appreciate that. Talking Munis. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
All Icon Enterprises investors are retreating after the company cut its quarterly distribution in half. More on the story from Bloomberg's Charlie Pellet.
Steve, the firm is paying out $1 per depository unit. That is down from the previous $2 a unit. Founder Carl Icahn blames a short seller report from Hindenburg Research for a second quarter net loss, doubling from a year earlier. Icahn says the firm will reset its focus on its core activism strategy and has also significantly reduced its hedges. Steve?
Thanks, Charlie. Shares of Icon Enterprises down more than 25%. It looks like the next chapter for Simon & Schuster reads like an acquisition, Bloomberg's Jeff Bellinger reports.
Steve, it's not in the books yet, but sources tell the Wall Street Journal that private firm KKR is in advanced talks to buy the publisher for roughly $1.65 billion. It's the second attempt by Paramount Global to offload Simon & Schuster. A potential sale to rival Penguin Random House was blocked by a federal judge. According to Simon & Schuster's website, the company publishes more than 2,000 titles annually. Steve?
Thanks, Jeff. Google's parent company faces allegations of union busting. The Alphabet Workers Union says the internet giant ended contract employment for a majority of Google help workers who sought to organize. The workers are employed through the vendor Accenture, but the union argues Alphabet is also legally their boss, and they want the National Labor Relations Board to designate the company a joint employer of Accenture staff. And those are the company stories we're following this hour. I'm Steve Rappaport. This is Bloomberg. Stay tuned for more Bloomberg Markets coming up.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Today's employment report, a little bit for everybody. Fewer jobs created than expected, but you also had faster wage gains than forecast. Investors seem to be latching onto the idea it may keep the Fed from raising rates higher again. S&P 500 and NASDAQ Composite Index attempting to snap a three-day losing streak. In the S&P 500 right now, you have 7 of the 11 major industry groups, they're higher. The best performer, that belongs to consumer discretionary, and that's where you're going to find shares of Amazon. Shares up almost 11% after the earnings report they delivered after the close of regular trading yesterday. So what's the next big data point? Consumer Price Index for July. Look for that next Thursday. Right now, the S&P 500, 23 points higher. That's up 0.5%. 45.25 in the index. The Dow Jones Industrial Average is up 182. The NASDAQ is up, NASDAQ 100, 94 points higher. 2-year yield, 7 basis points lower right now at 480. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Simone and Paul.
All right, John Tucker, thank you so much. We appreciate that. Simone Foxman, Paul Sweeney here in the Bloomberg Interactive Broker Studio. We're streaming live on YouTube. Just head over there and search Bloomberg Global News. You know, everybody's trying to figure out this inflation issue. Have we hit peak inflation? A lot of data points suggest absolutely, and that we're certainly going in the right direction. But I'll tell you one inflation thing that hits close to home for John and myself is gasoline prices, up about 10%. Just since the July 4th weekend. WTI crude oil up another 1% today to $82.35. So I don't know how that works out for all.
I may have to start scaling back on my wine purchases.
No.
Never.
That's going to hurt.
I will step in and subsidize that. Don't worry about that. So let's talk to somebody who thinks about the whole inflation / GDP and what it means for the markets. Quincy Crosby, Chief Global Strategist for LPL Financial. Quincy, thanks so much for joining us again. Again, we had a jobs print today. We've got a lot of inflation data points we've seen over the past several weeks. You put it all together. What do you expect our Federal Reserve to do in the coming months?
Well, you know, I always like to say that the Fed is data dependent, but I think the market is more ferociously data dependent than even the Fed. And, you know, next week we do get the CPI report. They've got over 45 days before they have to make a decision. But the fact is, I don't think that they are going to back down if they feel that inflation remains sticky and is not untangling fast enough. I think the market makes a mistake that the Fed will somehow say, well, let's just pause and wait and see. They're not going to wait and see that much. And besides which, you know, they don't want to get involved in the election season. That's something the Fed has always tried to keep away from. And but more than that, you know, they're focused on making sure that inflation moves in the right direction and doesn't have a chance to create another bout of inflation. And you mentioned gasoline prices. Granted, it's headline, but let's just face it. Consumers are very much affected by gasoline prices in terms of how they see future inflation. And that's something the Fed does not want to see.
Yeah, but isn't that sort of, I guess, the whole idea that the Fed can push against Saudi Arabia making decisions to extend its, production cuts? Isn't it just kind of a fallacy that the Fed has the true ability to control exactly what's happening with oil prices? And shouldn't companies have been factoring this in, just understanding that most of the commentary from energy analysts was that oil is probably going to be tight by the end of the year?
Well, yeah, no, the Fed can't. I mean, the Fed, look, the administration couldn't. President Biden went to Saudi Arabia to try to come back with a good deal and just the opposite. So they have their own vested interest. We know what it is. It is to get oil prices up as much as possible. Their budget is huge. They're building cities. They're trying to create a landscape post-crude oil, and that requires higher oil prices. So the market had expected that before today's panel discussion that they're having online, that the Saudis would come in and say, hey, we're going to extend those quote unquote voluntary cuts through September, which they did. But what's interesting about this is that it didn't work. I mean, when the market was fixated and obsessed by recession, it actually made no difference about the production cuts. Absolutely no difference. So now all of a sudden, when you have sort of a light at the end of the tunnel in terms of the GDP growth in the country, suddenly the question is, what about those prices? What's going to happen? Look, without some exogenous shock, it's hard to see that they're going to get oil prices up to $90 a barrel on WTI. But you see, it's already moving up above 80, a little bit. Companies do well. American oil companies do well, $45 a barrel. But the fact remains, for the average American, we know this statistically, they may not even drive. They may drive electric vehicles. But when they see those prices inching higher, the 1 year and especially the 3 year projections for inflation move higher. And here's the other statistic that goes right along with it. Then they blame the administration, regardless of power, regardless of party.
All right, Quincy, we've had about 80% of the S&P 500 companies report here. Do you feel like we're at an earnings trough here, or how do you think about earnings going forward based upon what you've seen so far in this second quarter?
Well, it's been a discerning market. It has not been a market that has, given a pass to companies that are even missing slightly. They've been punished. But the fact of the matter is there's resiliency in the companies, obviously ex energy. But the fact of the matter is we also see that 2024 will see a nice climb higher with companies. The thing to look for, though, to push those prices higher, the share prices higher, is that we also expect to see a pullback in the amount of share buybacks. And, that has been a tremendous catalyst for the stock market.
Quincy, talk us through a little bit more on the jobs report today. Was there a surprising detail for you to come out of this in terms of where we're headed?
Well, it was interesting to see the unemployment rate come down, right? And then to see the wage growth remain, quote unquote, sticky. The Fed doesn't want to see that. And why that's so important is there is a political tug of war about it. You can see it in the political parties, but you also see it on Wall Street. Why does that bother the Fed? Why does that bother Chairman Powell specifically? Why can't he be happy about the higher wages? Because they're going to low wage earners. And the fact is, the concern from a completely apolitical perspective is companies want to pass along those costs. Once the wages are higher, it is an input cost, and it is one of the most important input costs for companies. So it hasn't leveled off. Everyone was expecting 0.3%. It stayed at 0.4%. That is what was so surprising. The expectations and the hopes were, let that come down, and boy, will we celebrate, because I think the market felt that'll clinch it. The Fed is finished.
All right, Quincy, given that backdrop as it relates to interest rates, that backdrop as it relates to some of the economic conditions out there, and we had Mr. Goolsbee from the Fed talked to David Weston today from Bloomberg, saying that they're trying to walk that fine line of keeping inflation in check while not push his economy into a recession. Given all that background, I got a market that's doing great this year. The S&P 500 is up about 18%. The NASDAQ's up about 34%. Yeah. How much more do we have to go here? Should I be jumping in here? What's your call?
Well, in terms of seasonality, unless there's a surprise and this turns out to be a good season as opposed to choppy and dicey, how many catalysts are there right now? Maybe next week the CPI report could be a tremendous catalyst to push this market up despite the negative seasonality. So if we start to see that core come down, I think it could be again a catalyst to keep the market moving higher. But earnings are an important catalyst, and obviously we're going to get a retail picture about the U.S. consumer with the consumer names. But remember, it has been led by the big tech. That's what started all of this. The big tech, mega tech led. So maybe you have to wait until August 23rd for NVIDIA to come out. That was the one performance. It was a triple play, right? Revenue growth. Bottom line, the guidance was stupendous. And what it did was it confirmed that high move in the mega tech, anything associated with artificial intelligence. They're coming out on August 23rd. The market may have to wait for that. But overall, if we could see that core, super core inflation coming down at a quicker pace that untangles the stickiness, that'll be a tremendous catalyst for the market, regardless of seasonality.
All right. Appreciate that. Quincy Crosby, Chief Global Strategist, LPL Financial. Always appreciate getting Quincy's perspective here. Simone, are you a Swiftie?
I am, I guess.
Have you seen a show?
But I have not seen a show.
I'm just looking at on one of the networks up there, a couple of data points. She just added some more U.S. dates. So the expectation is her tour, when it concludes, will have $1.4 billion in ticket sales, and the revenue per person, per guest or per attendee, $1,300. So I guess that's the ticket price plus the merch and all that kind of stuff. But man, how about
ticket price
I
inflation
will argue
right
she's a better businesswoman than she is a performer, and that's saying something.
She's great in both, so good luck to her. All right, right now let's head down to Washington, D.C., world and national news with another suspected Swiftie, Nathan Hager.
Guilty. Thank you, Paul.
Knew it.
Got to start with some breaking news here. Another mystery may be solved in the Gilgo Beach killings. Authorities say they have identified the woman who was long referred to as Fire Island Jane Doe as Karen Vergata. Suffolk County District Attorney Raymond Tierney made the announcement.
There are no charges at this time. Miss Vergata's disappearance was in 1996, which is 27 years ago. We are going to continue to work this particular case as we did the Gilgo 4 investigation.
Suffolk DA Ray Tierney didn't comment on what, if any, suspects they've developed in Vergata's death. Rex Hewerman was arrested last month in the killings of 3 Gilgo Beach victims. He is the prime suspect in a 4th. Former President Donald Trump has built on his lead in national polls after now 3 criminal indictments. But the latest survey of caucus goers in Iowa may point to a vulnerability. A New York Times Siena College survey out this morning gives the former president a 24-point lead over the first runner-up in the race, Ron DeSantis, in the early caucus state. 24 points, but that's less than the 37-point advantage the former president enjoys in nationwide polls. DeSantis has been focused on early voting states like Iowa as he resets his campaign. A Russian Black Sea port was closed for several hours today after a Ukrainian drone strike on a naval vessel. Russia's defense ministry says the drones were repelled without damage to port facilities, but it is the first time a key Russian shipment point for oil and grain was disrupted in the war. Russian opposition leader Alexei Navalny has been sentenced to another 19 years in prison on extremism charges. The leading critic of President Vladimir Putin called the case Stalinist. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Right now, the major averages are all higher, yields are lower, and even as wages grew at a solid pace, traders did cut back on bets for another Fed interest rate hike this year. That's based on job creation. This morning's Labor Department report. It did fall short of expectations. S&P 500 halting its three-day drop. Two of the benchmark's biggest companies going opposite ways. Amazon jumping over 10%. They had that bullish revenue forecast. Apple falling after that disappointing outlook. Meantime, Sarah Hunt, the chief market strategist at Alpine Woods, says the rally in tech shares so far this year is justified by the earnings.
I think so far they may have. The question is going to be about what is coming next, right? So that it's all about the outlook right now. So it's very good that Amazon had good numbers. If you look back at the way Amazon has performed versus Microsoft or Apple, it was not performing as well. So it did need to do something, relatively speaking.
Right now, the S&P 500, 22 points higher, up 0.5%. We're at 45.24 on the index. The Dow Jones Industrial Average up 185 points. The NASDAQ 100, 92 points higher. That's up 0.6%. Two-year yield is down 7 basis points, 481. The 10 down 10 basis points at 4.07%. Earnings scorecard. 420 companies in the S&P 500. They've reported so far 80% of those have delivered positive earnings surprises. And we check the markets for you all day long. Right here on Bloomberg Radio, I'm John Tucker, and that is your Bloomberg Business Flash. Simone and Paul.
All right, John Tucker, thank you so much. Good stuff there. Simone Foxman, Paul Sweeney here in our Bloomberg Interactive Broker Studio in New York City. We're streaming on YouTube. Just head over there and search Bloomberg Global News. Looking at the risk-on take in the market today, I'm going to ascribe some of the move today, some of it, potentially to the comments from Austin Goolsbee, president of the Federal Reserve Bank of Chicago. He was interviewed by Bloomberg's David Weston earlier out in Aspen, Colorado, which is a scam in and of itself. I'll get to it later. But he said he feels that the Federal Reserve is making some headway, having some success on walking that fine line between fighting inflation, but without pushing the economy into a recession. So maybe that's helping things out. But let's check in with somebody who does this stuff for a living. Jonathan Hurdle, he's executive chairman, Hurdle, Callahan and Company. Founded that company back in '88, was at Goldman Sachs before there. Was an officer in the U.S. Marine Corps from 1975 to 1982, so we certainly thank him for his service there. But for me, the highlight is the MBA from Penn State. Good stuff there. Hey, John, you're out in Wyoming. Why, I don't know. But you're out in Wyoming. Yeah, you're wearing a garb like you'd wear on Wall Street. Dude, you got this nice shirt, this tie. Isn't that a little formal for Wyoming?
It is a little formal for Wyoming, but we're managing $20 billion, and we need to pay attention wherever we are.
That's what I like to hear. Very good. So, Jonathan.
Good morning, Paul.
Good morning, sir. How do you feel about this market? Because we're looking at the S&P up 17, 18%. We've got the NASDAQ up 34, 35. And boy, that's been a heck of a run off of a terrible 2022. What are you telling your clients these days?
Well, it's pretty much as steady as she goes kind of a market here. We have negotiated, as Austin Goolsbee has said, you know, we're sort of on a golden path. You just mentioned his name. So we've been able to avoid a recession. Inflation is coming down. Wage growth is increasing, but not so much to be a problem. So it is, amazingly positive, all the things that are coming together here. And, you know, the United States is doing better than the rest of the world. This free enterprise thing seems to be working. And, you know, we've got terrific managers in this country. See, we just heard on the Bloomberg Business Flash that 80% of reported earnings have surprised, either met or surprised on a positive side. So good things are happening. The excesses that we worried about don't seem to be coming through. So it's just everything's working right now.
Well, we're seeing, continually added jobs every time we get a jobs report number. We're seeing those bright spots for corporate earnings. Are things too good? I mean, is this going to push the Federal Reserve to continue to raise interest rates maybe more than we had and than the market even is anticipating?
Well, good morning, Simone. My sense is, you see the 10-year coming down 10 basis points today, and that the jobs report has taken a touch of pressure off the Fed's need to raise rates. But even if they do raise rates, I think it doesn't matter at this point. We've got a picture in place. What we need to worry about, what we're worrying about is the things we always worry about, like exogenous risks. But the actual fundamentals of the market are sound and positive. We do have a high price earnings multiple on the market relative to averages. But my sense is this is another signal from the market that we think we're going to have long-term interest rates coming down. So, the 10-year Treasury, we still have an inverted yield curve. But the real return on the 10-year Treasury is not particularly high. And so that tells us that over the long run, and also another thing is this inverted yield curve. One of the things that tells us is that the long-term rates, we still think are low, but short-term we have policy things going on that might raise rates. So this notion that we're sort of in this sweet spot continues. So, it is true that it's like we're all neurotic. So if things are good, we worry they're too good, and if things are bad, we hate that. So, but we're in sort of a sweet spot here where everything seems to be working. We're walking that line, and we have to give credit to corporate managers because our way of thinking is that, it's always about buying future cash flows, and that comes from earnings. Another thing that's really a positive impact relative to the last 10 years is, for the first 30 years of my career, we had real bond yields to work with.
Yep.
Bonds were an important part of the portfolio. For the last 10 years, that has generally not been true. But right now, we're starting to get real yields again in the bonds, and even money market funds. So that's a terrific tool to have back in our toolbox.
So, John, if I sit in a 2-year Treasury, I can get 4.81%. That seems pretty good. But I feel like it might be the time to maybe go out on the curve a little bit, maybe get some more duration. Should I do that, or should I just sit comfortably with my 2-year?
Little of each. In other words, one of the things we really believe is you can't predict, you can only prepare. So when you have a 2-year Treasury yielding almost 5%, why not? And on the other hand, if you have a full duration, we're a little bit under duration on our bond portfolios today.
Connection
but
lost.
We've been adding duration as interest rates go higher. If you do have a pullback, this is what it means. We can't predict this. No one can predict it. But if you did have a pullback, then having that and interest rates fell, then having longer duration would give you some protection against a pullback in the stock market. And, meanwhile, you're picking up that coupon. So it's a little bit of each. Find the most compelling things you can find, and then believe each one a little bit.
Yeah, what's the top asset class in which you're adding your marginal dollar at this point?
Well, we're overweight U.S. and we're overweight things like healthcare equipment and the technology stocks as a consumer-facing technology stocks and software. So we're really continuing to focus on these companies that have strong market share, strong balance sheets, and moats around them to protect them from competition. So that's still our portfolio is overweight U.S. and overweight that sector. Marginal dollar comes in, we're still doing that.
John,
we also are looking for, that's the core portfolio. And then on top of that, of course, we're always looking for opportunistic things, for example, like private credit, which is a whole other discussion, and it really matters what segment you're in and which managers you're using and so forth.
John, it looks like a beautiful day out there in Wyoming. How are our friends out there in Wyoming? Having a good summer?
Everything's good. It's, my friends in the East are worried about hot and humid. It's not hot and humid here. And, we've got the Jackson Hole Fed meeting coming up, but I think it's going to be a relatively sort of a non-event compared to recent years, where it's been so dramatically important.
Right. Hey, John, thanks for taking a few minutes. We always appreciate getting your thoughts and your perspective. Jonathan Hurdle, he's the executive chairman of Hurdle, Callahan and Company, coming to us from beautiful Wyoming out there, so good for them. S&P 500 up 0.6%. The NASDAQ now up 0.9%. Again, WTI crude oil, we're going to stay on top of that, up 1.25%, now at $82.57. Energy costs creeping back higher. This is Bloomberg. Let's get some company news right now with Mr. Stephen Rappaport.
All shares of Icon Enterprises are spiraling. This after the company slashed its quarterly distribution in half. More on that from Bloomberg's Charlie Pellet.
Steve founder Carl Icahn blames a short seller report for the firm's second quarter net loss doubling from a year earlier. Icahn Enterprises says it will pay out $1 per depositary unit, down from the previous $2 a unit. Shares in Icahn's firm have fallen more than a third this year, largely on the back of a Hindenburg report in May that accused the billionaire activist of costly missteps. Steve?
Thanks, Charlie. Icahn's stock is down more than 25%. A drug developed by AstraZeneca and Sanofi to protect infants against a potentially fatal respiratory illness clears another hurdle. More on that from Bloomberg's Joan Doniger.
Steve, a panel of advisors to the Centers for Disease Control and Prevention unanimously backed the drug. The advisors are recommending a dose of Beyfortus for infants less than 8 months old entering their first RSV season. RSV causes inflammation of the airways, leading to difficulty breathing. The monoclonal antibody is among the first medicines available for wide use to protect infants from the illness. The FDA cleared Beyfortus last month. Steve?
Thanks, Joan. AstraZeneca stock is up less than 0.25%. And the lawsuit accuses Amazon of shortchanging remote workers out of overtime. According to the complaint, remote workers must be ready to field customer service calls at every moment of the shift. That means they have to boot up computers and work programs without pay before clocking in. Those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, Simone Foxman, Paul Sweeney here in the Bloomberg Interactive Brokers studio. Looking at Bitcoin, Tom Keene's not here, so we're going to quote Bitcoin. It is absolutely unchanged today, 29,259. So some stability there in Bitcoin, but we're focusing on the yield curve here. Yields were a little bit higher, but now they are lower. 10-year Treasury off just about 10 basis points, 4.08% on your 10-year. The 2 years off 6 basis points, 4.82. So still some inversion on the yield curve, but less than where it was a couple of weeks ago, and we'll keep an eye on that. Right now, let's head down to Washington, D.C. We'll get world and national news with Nathan Hager.
Paul Sweeney, there is another development in the Gilgo Beach murder investigation. Authorities have identified a woman whose remains were found along the Long Island coast nearly 30 years ago. Bloomberg's Michael Barr reports.
Investigators say Jane Doe number 7 was Karen Vergata, who was 34. Suffolk County District Attorney Raymond Tierney.
There are no charges at this time. Miss Vergata's disappearance was in 1996, which is 27 years ago.
Tierney says Vergata had been living in Manhattan. Police are trying to determine whether Vergata was a victim of serial murders going back at least a decade along Gilgo Beach. Rex Heuermann was arrested in the deaths of 3 women and has been named as a prime suspect in the killing of a 4th. In New York, Michael Barr, Bloomberg Radio.
Russian opposition leader Alexei Navalny has been sentenced to another 19 years in prison after being convicted of extremism. The verdict came at a closed-door hearing inside a penal colony where Navalny is already serving a 9-year term for fraud and corruption charges. President Vladimir Putin's most outspoken critic had already described the latest verdict against him as Stalinist. A candidate for the Republican presidential nomination is on a surprise trip to Ukraine a day after former President Donald Trump pleaded guilty to charges related to the January 6th investigation. Former New Jersey Governor Chris Christie met with Ukrainian President Volodymyr Zelensky and toured areas near Kyiv that were devastated in the early days of the Russian invasion.
Lots of discussion in our country about what to do. And I think if the American people see the sacrifices that you all have made, it will allow us to continue to support all of you in the fight against the Russians.
Former New Jersey Governor Chris Christie is the second Republican presidential hopeful to visit the war zone. Former Vice President Mike Pence made the trip back in June. The heated debate over the value of remote versus in-office work may have new ammunition in a new study from economists at the Massachusetts Institute of Technology and the University of California, Los Angeles. They found that workers randomly assigned to work from home full-time were 18% less productive than those in the office. The researchers studied newly hired data entry workers in India. They said 2/3 of the drop in productivity was evident from the first day of work. The remaining difference came when in-office workers learned more quickly than their fully remote counterparts. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. In my office, I'm Nathan Hager. This is Bloomberg. Paul and Simone.
Nathan, thank you so much. Well, I guess if this RTO return to office really accelerates, then perhaps fewer people are traveling in the United States. Fewer people are able to work remotely from wherever they are, maybe the beach. And that's been really evident in some of the share prices around domestic carriers this week. This is one of the worst performing sectors so far this week. We're looking at the likes of JetBlue down 15.5%. Spirit Airlines down 11%, and lots of these carriers cutting their yearly outlooks. This was supposed to be a massive summer boom, but we're in fact seeing airline ticket prices fall, and a lot of these players, talk about a different future.
Yeah, I guess, the post-pandemic travel surge had to fade at some point. I didn't think it would be this summer. This actually surprised me, hearing from the JetBlues and the Alaska Airlines of the world in the Southwest that really focus on U.S. domestic travel. But it's good news for consumers. But but I'm sticking with my strategy. I'm only traveling if you pay me to travel.
Well, prices now at their lowest for airfares since March 2022.
All right, interesting. So we'll have to see how that plays out. Every time I'm on a plane, it's packed. But we'll see how it goes going forward. We're going to have more coming up. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, we're going to kick it off with a discussion about global energy. It's moving higher. Is that going to be a driver of inflation going forward? Mike McGlone, senior macro strategist with Bloomberg Intelligence, and Fernando Valle, he is the Bloomberg Intelligence senior analyst covering the energy space. They're both going to join us, and we'll kick it around and see where the future is for global energy. Jeff Cleveland, he's the chief U.S. economist at Payton & Rego. He's going to join us to discuss those jobs numbers today. And then in our C-suite conversation, Sandra Kinsey, CEO of P4P, that's Paradigm for Parity. We're going to talk about parity, diversity in the senior ranks of Wall Street banks. Are we making any progress? That's kind of where we want to get to. So we'll check that all out. But first, let's go to Charlie Pellet and start this hour.
Thank you very much, Paul Sweeney. Stocks just about the highs of the day right now. The S&P up 28 jobs Friday. S&P is at 4530. That is a gain right now of 0.6%. The Dow up 220 points, also higher by 0.6%. The Nasdaq Composite Index up 0.9%. And the Nasdaq 100 Index also higher now by just about 0.9%. 10-year yield 4.08% with a 2-year 4.82%. Spot gold up $8.50 the ounce to $19.42, up by about 0.4%. West Texas Intermediate crude oil up 1.2%, 82.53 a barrel on WTI. Wall Street saw a reversal of the moves of the past couple of days. Stocks rising, bond yields falling after a mixed jobs report. Reaction to the jobs report from Tom Gimbel, who is the CEO and founder of recruiting firm LaSalle Network, who spoke right here on Bloomberg Markets with our Simone Foxman and Paul Sweeney.
We have 187,000 jobs added. I mean, are we kidding ourselves if we say it's not a good jobs market? It is a really, really strong market. I think it sends the right message to both Wall Street and Main Street, is that the market is still very, very healthy. And at the same time, it sends a message to the Fed that it's down a little bit from where it was. So we'll probably see a little bit of a hold at the next rates meeting, and they won't raise.
And you can hear more of that conversation on the Bloomberg Tape podcast. You can download it wherever you get your podcasts. Carl Icahn slashed his company's quarterly payouts in half and pledged to, quote, stick to our knitting in another substantive move, acknowledging complaints raised by short seller Hindenburg Research earlier this year. Today, Carl Icahn Enterprises, ticker IEP, down now by 23.8%. After earnings, Apple shares down 2.9%. After earnings, Amazon rallying now by 10.8%. Recapping, a move higher for stocks, S&P up 28, a gain now of 0.6%. 10-year 4.08%, the 2-year 4.82%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Charlie Pellet, thank you so much. We appreciate that. As Charlie is mentioning, decidedly higher move today. How about that? We'll take it.
Yeah, enthusiasm to end the week.
Exactly. That is a good thing. And let's check in with Alexandra Semenova. She covers all the equities here for Bloomberg News. She joins us here in our Bloomberg Interactive Broker studio. Alex, what are you looking at today on a busy day?
Yeah, so what we're seeing today is a tale of two big tech stocks. Of course, Apple shares are down on concerns over iPhone demand. But then on the bright side, you have Amazon rallying, shares up nearly 11%. That's thanks to earnings yesterday that showed strong revenue growth from its core e-commerce business, as well as signs of stabilization in its cloud computing business. Everyone is hailing CEO Andy Jassy for this really strong report. Since taking the helm about 2 years ago, he has fired 27,000 1,000 workers and vowed not to grow headcount. He's also hit the brakes on some projects that Jeff Bezos had underway and put multiple existing businesses Amazon was working on under review. That helped the company achieve this double whammy of strong revenue growth as well as curbing its spending. I always like to read what the analyst reactions are to these earnings. Evercore ISI, which raised its price target on the stock, said this quarter provides, quote, an unlock on the stock. Nice. Analysts there said the report addresses two of the key questions that they had, a recovery in retail margin and a reacceleration in AWS revenue.
Yeah. And I have to call out, just Simone, I'm just going to throw a pat on the back, which I'm reluctant to do to my analyst, but Anurag Rana, Bloomberg Intelligence, he called this months ago. He said this quarter is going to be the trough for AWS and watch out for the back half of the year, and he was right. So a little pat on the back for our boy there.
Yeah, absolutely. And the street extremely positive on Amazon. 60 buy ratings, 4 holds. How many sells? 0.
I mean, how much value add is that 64th analyst providing on Amazon? It's just crazy. Ergo, the problem with the research model on Wall Street. What else are you looking at?
Airbnb is an interesting one. Shares are moving higher today after the company reported second quarter revenue that did beat Wall Street estimates. Analysts viewed the results as pretty solid, with bookings and revenue coming in ahead of their expectations. They did, however, flag slower room nights growth. People booked 115 million nights and experiences on the platform in the second quarter. That's up 11% from a year ago, but the slowest pace of growth since pandemic shutdowns. Piper Sandler said that the results were solid and its business is impressive. However, it struggles to see a clear path to multiple expansion from here. I don't know about you guys. Do you guys prefer hotels?
Well, that's what I want to ask. You guys are the demo for Airbnb, I like to think. So are you guys Airbnb users?
I am more of a hotel person. I think with the costs all in, it just makes sense to get a hotel where, you have housekeeping service. You don't have to pay for all those cleaning fees, which is something that Airbnb has been struggling. The costs pretty much don't make sense anymore.
Yeah, I'm in my mid-30s now. I like someone to pick up all my stuff, make the bed for me, when I'm not at home.
Because my daughter, she's 27. She took her mother and her brother over to Europe for like 2 weeks. Did it pretty much all Airbnb, and apparently it worked out great.
I think it offers like a really differentiated experience, like when you are going with friends as a group, or when you're going somewhere around an event. That's the time.
Although it was cool. The only time I've done it, it was Bloomberg got it for me, and it was in Cannes, France, and it was a cool French, apartment, which was really on this little street, which really made you feel like you were getting the full local thing. And I can see the value of that.
Yeah, I feel like if you're looking for something specialized and want a very particular type of stay, then Airbnb is the way to go.
All right.
Yeah, and interestingly, I should point out that Airbnb was one of those laggards last quarter. It did not have the same incredible demand we saw from so many hotels, from so many of the other big travel players, but now seeming to do a little bit better than anticipated. And that's probably part of the positivity that we're seeing in the market today.
All right, Alex, thanks so much for joining us. Thanks for that update on what's happening in the markets. Alex Semenova, she covers equities for Bloomberg News. We got movement higher yet again in energy. WTI crude oil up 1.2%. I've been calling this out for the last several weeks. This WTI crude's had a nice little run here. I don't know what the heck's going on. So let me bring in a couple people that we pay to know what's going on here. Mike McGlone, senior macro strategist with Bloomberg Intelligence. He's located in the self-proclaimed crypto capital of the world, Miami Beach. Good luck with that. And Fernando Valle, senior analyst for Bloomberg Intelligence. His whole career is kind of doing this energy thing. So let's start off with Mike. Mike, just from a technical perspective, this thing was $67 a barrel WTI crude oil like 5 weeks ago. Here we are at 82. What's going on?
We're seeing a decent bounce of a market that got very oversold. Managed money, net positions were very short. The market bounced from its 60-month moving average. But the key thing to remember about crude oil, juxtaposed to the stock market, which has that mantra, if it goes up, it will go up. In crude oil, it's the opposite. Remember, and the price you see on the screen was first traded in about 2007. It's when it goes up, it usually makes it go back down. And right now it's rallying on the back of not only that, positions coming back, but the stock market's going up and yields are popping. But I view this as a bear market rally, and I have good bias from that. The high was put in 2008. We had that bounce up to last year that was lower than that high, around 130 recently, and now we have a situation with OPEC cutting supply and Russians saying they're cutting supply, but that's typically what happens in bear markets from a cartel. They see this yield curve, they see the global bent towards recession, they see the declining economic growth out of China, they see the U.S. rapidly raising interest rates, and they see the risks of crude oil going lower, and this, what it normally does is it mean reverts. The question is, where is it peak and where does it go? So I look at these levels. 83 has kind of been the high since looks like about November of last year. So I see we're near the upper end of the range now.
All right, Fernando joins us here in our Bloomberg Interactive Broker Studio, paying $3.83 a gallon to fill up the Beamer at the Jersey Shore. That's much higher than I want to pay. Why can't, and people are telling me there's a refinery issue, which I'm not buying, by the way, but that's an excuse. Talk to me about the refining situation in this country. Do we have a refinery down or out, or what's going on?
You're not buying a refinery, or just
no?
Not buying
I want to buy. I'll tell you what I want to do. I want to go down to like Corpus Christi or Gulfport or wherever they put those things and build a refinery. Can I do that?
You can just revamp some of the recently shuttered refineries, including in Louisiana and in Philadelphia. Well, that one's going to take a lot of work. But yeah, we do have some refinery shortages. And when you look, it's not just crude prices that are driving gasoline prices higher. Crack spreads are $40 a barrel for both gasoline and diesel.
So crack spread is the difference between what I pay for a barrel of oil and what I sell the stuff for?
The diesel and the gasoline that you produce out of it.
So if I'm a producer, I want a bigger crack spread.
Exactly.
Nice.
And they were getting, it's over 3 times what they usually get. So they're pretty healthy, and that just goes to show you that we are really short on the refining capacity. And I'll make matters worse. It actually looks worse in Europe, especially on the diesel side, because they don't have Russian crude. They've lost a lot of refinery capacity over the past 5 years, and electricity prices there are significantly higher. So we're going to need a lot more diesel, and it's not going to get cheaper anytime soon.
Yeah, but we also see, U.S. producers boosting production. The shale producers that stayed on the sidelines, preserved their, fiscal picture, as even the Biden administration was telling them to get back out there to get pumping. I mean, does that kind of offset? Sure, we have this maybe bottleneck in refining, but then does that sort of offset what we're hearing from Saudi Arabia around continuing those cuts? Does that kind of put an upside ceiling to where we go with oil prices?
Well, the limit is really on the demand side, as Mike was alluding to. The shale producers can only grow so much. There are a variety of limitations. I think the biggest and most important is the geological limitation. You just can't grow as fast as you hoped because the productivity isn't there. And then outside of the Permian, you just don't have any investments. Even when you look at the rig count, it's still relatively low. Frac spreads, they're not back to their peaks before 2020. And so we're not going to see that sort of growth. And ultimately, when it comes to gasoline and diesel prices, you have an added issue, which is what we produce in the U.S. is not really set up for what we refine in the U.S. And we need a lot more heavy crude. And when OPEC cuts barrels, they cut the stuff that we need, which is the medium and the heavier grades. And that makes, especially diesel, more expensive.
I don't know how that all works. Mike McGlowan, talk to us about kind of just the trading here of WTI crude, or just the other energy components here. How much of it is really technical versus the fundamentals that Fernando's talking about?
Price is the number one factor in crude oil, and what drives price? Futures traders. I just love pointing that out because I actually am an ex-futures trader, and I've spent a good portion of my career running money and dealing with clients doing that. And that's the bottom line, is it's really price that drives it. And then why do you see OPEC worried about cutting? Because they see what's happening, they see prices going down. But the bottom line is we're still well above the average cost of production, the world's largest producer net export of the U.S. And one thing I do point out and like to point out is how things have changed. Now, this is just a little bit of where Fernando and I disagree is rig counts declining is actually a very bearish sign for crude oil, because if you look at there's been a very high correlation with rig counts for the last almost 20 years, partly because when you drill down one drill, you can go horizontal, who knows how many ways, but it's just a fact of what I show in prices. And I love pointing this out a year ago, is the fantasies of crude oil, where people still focus on those kind of things. And then people talk about lack of investment. I'll be going out to the farmland again in next week. And, in this country, we get almost 15% of our total unleaded gas now from ethanol. And that demand for unleaded gas in this country is actually declining. It's down 5% than when it was before COVID. So, and this major bent towards EVs. So I look at it as, this is an enduring bear market that's just catching up. If you want to look for a good bull market in commodities, look for gold. The price today, this year, is the average price for gold this year is the highest ever at $1,936 an ounce. Crude oil is just the average price here is 75. That's meh. That's just a normal price. It's just fluctuating around that average.
So I'm going to quote, I think I can summarize Mike McGlone's commodities call: buy gold, short everything else.
Exactly. That's the trend.
He makes a living on this. It's unbelievable. He gets paid to do this stuff.
No, I mean, his commentary here is pretty, that he writes for Bloomberg Intelligence, is pretty harsh. Either we are reversing our trajectory since 2009 in an upward trend, or we're in the early stages of a severe economic contraction. And he, by the way, believes the latter. I mean, Fernando, what's your take? Do you disagree? I mean, I know you specialize in the energy space, but
yeah, absolutely. I think I agree with that the demand side of the equation is the biggest driver in the short term, and Mike and his view on the short term is very aligned. We think that's probably the lower price than what we're seeing on the screen right now. But then on the long term, where I'll disagree with Mike is because my homeland is poor and doesn't have a lot of energy.
And that homeland for people is Brazil.
And we're not buying EVs. We went through blackouts throughout my childhood, and OECD, the developed countries, are now less than half of energy demand globally, and the only area that grows is emerging markets. So they are the biggest drivers, and when you look at China having to buy more coal because they don't have enough energy, India, and Pakistan and their challenges with electricity, believing that the whole world's going to be driving a Tesla in 10 years is just completely nonsense to me.
All right, so are your companies, your global energy companies, are they investing enough in the fossil fuel infrastructure?
I mean, Exxon and Chevron plan to grow 2 to 3% a year, and while BP and Shell are thinking they're going to decline. So no, in the long term, we're not. And then there's a question on whether Saudi can actually grow much more than they do. They always talk about a big game about growing production, and then for the past 15 years, they've been pretty much flat. So there's a lot of questions there. We don't think we have enough energy long term, and solar and wind won't cut it in the next 10 to 15 years.
All right, there you go, folks. I think that's some of the smartest conversation you're going to get on energy. Coming from a commodities perspective as well as a fundamental analyst who talks to these companies every day. That's Mike McGlone and Fernando Valle. They're both from Bloomberg Intelligence. I wonder who hired them. Anyway, there's good view on the energy space there, and we appreciate getting a few minutes of their time. Again, WTI crude oil up 1.3%, $82.60 a barrel. S&P 500, we're still holding those gains, up 0.6%. More coming up. This is Bloomberg. Let's do some company news right now with Mr. Steve Rappaport.
All shares of Icahn Enterprises are plunging, down more than 22%. Bloomberg's Denise Pellegrini is tracking developments.
Steve, this is that investment company owned by Carl Icahn, and it is cutting its quarterly dividend in half to just $1 per depository receipt, and also reporting a widening net loss and a second quarter revenue that plunged 27% from a year ago. In a letter to shareholders, Icahn blames company's troubles on what he calls a self-serving and misleading report by short seller Hindenburg Research. Icahn also says the company plans to stick to its knitting and undertake a reset by trimming its own short bets and focusing on the activism that made Icahn a famed investor in the first place. Hindenburg, meantime, saying on X, the social media company formerly known as Twitter, that it remains short on Icahn Enterprises. Steve?
Thanks, Denise. Apple loses its historic valuation of $3 trillion. Bloomberg's Gina Cervetti has more.
Apple is being hurt by an industry-wide slump in smartphone demand, and the company reported its third straight quarter of falling sales. Apple also sees something similar for this current quarter that we're in now, and that would mark the longest period of declines in 2 decades. But record-setting services sales helped overall revenue, which came to around $82 billion, and that was better than expected.
Thanks, Gina. Apple stock is currently down more than 3%. And shares of Airbnb currently up after the platform beat estimates for the second quarter revenue. People booked more than 115 million experiences and nights on the platform that quarter. I'm Steve Rappaport, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. We've got the Dow, the S&P, and NASDAQ all advancing. Session highs right now on the S&P up 29 points, a gain of 0.6%. S&P at 4530 as we wrap up the trading week. We have got the Dow up 206 now. That's a gain of 0.6%. NASDAQ Composite Index up 0.9% right now. Bitcoin is at 29,239, lower by 0.2%. 10-year yield 4.07% with a 2-year 4.81%. Spot gold up $7.50 the ounce to $19.41, up 0.4%. While West Texas Intermediate crude is advancing 1.5%, $82.75 a barrel. Well, reaction to this morning's jobs report from Chicago Fed President Austin Goolsbee, who spoke with our David Weston in Aspen, Colorado.
Job market is cooling a little to kind of a balanced level, but it's still extremely strong. That's the strongest part of the economy by far, is how low the unemployment rate is, and people can get a job if they want a job.
And you can hear more of that conversation on the Bloomberg Markets podcast. You can download it wherever you get your podcasts. Carl Icahn slashed his company's quarterly payouts in half today and pledged to stick to our knitting in another substantive move, acknowledging complaints by short seller Hindenburg Research. Shares of IEP, Icahn Enterprises, down 23% now. Amazon after earnings higher by up now by 10.6%. Also after earnings, we've got Apple shares moving lower now by 3.1%. Coinbase, among the companies reporting earnings last night, Coinbase shares today down by 1.2%. Again, recapping, stocks higher, S&P up 0.6%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate it. Again, payroll day, jobs day today. I think it was a solid number all around. The thing that jumped out at me was, average hourly earnings. It's pretty darn healthy, up 4.4%, kind of consistent with last month. I'll take that. I wonder if our next guest is with me here. Jeffrey Cleveland, Director and Chief Economist at Payton and Regal. Jeffrey, I'd love to get your takeaway from what we saw on the labor front, and maybe more importantly, how our Federal Reserve is going to view this number.
Well, I think this is a very soft landing-ish, I don't know if we can use that term, type report.
Yep.
You had solid payroll growth. Of course, payrolls have been slowing over the last year. Everyone knows that, but the 3-month average is still 218, which at any other era we would say is stellar job growth. So that's very good. The one drag or one sector that's been problematic is also one that everyone knows: information, sort of the technology type sector. So that's well known. Everything else, we're seeing pretty broad-based gains in employment. The unemployment rate is still low. I think we're just above the cycle low at 3.5%. So this is the part I find most amusing, where the Fed has been hiking. It's an historic hiking cycle, the most rapid hiking cycle in 40 years, and the unemployment rate is below where it was when the hiking cycle began. So,
I like you point out that job leavers as a percentage of total unemployed in July's employment report rose to 14.6%. You sent us some notes across earlier. That's like a cycle high. That is even a stronger data point for this report than the overall headline number, which I guess missed analyst estimates generally. Why is this, I guess, just not a bullish, let's go get them kind of sign? It seemed, if we're seeing this soft landing picture, then it suggests that at least the Fed's going to kind of stay back on the sidelines.
Well, I think that's the importance of the soft landing, story. It's not just semantics. It is a indication. If the soft landing is playing out, then maybe the Fed doesn't have a lot more to do. And I think you see that today. The equity market loves that. The bond market will love that as well. I talk to bond traders every day. They would love it if the Fed is done. So if we are on the soft landing, then arguably the Fed is done.
Yeah, but I guess sorry, go on.
No, I mean, you bring up the kind of an important issue is that maybe this job market is even stronger than this report suggests. When you dig into the internals of the report, still some great signs that could be that we'll have continued growth. The unemployment rate will go even further. Wage growth will remain 4 to 5%. And I think in that environment, the Fed might not be as pleased as the markets are today with the report. That could be a situation where you have a no landing type scenario where the economy is still above trend, low unemployment, solid wage growth, and inflation is too high. It's above 2%. The Fed probably has more to do in that case, in that environment. So I think that's still a real risk, that scenario. But right now, everyone seems to be glomming on to the soft landing.
So are we taking recession off the table?
Yeah, we took it off the table a while ago. We thought after SVB that there was a risk that credit was going to contract more significantly. That hasn't played out. I was just looking at the lending data, the weekly Fed data. I mean, lending growth has slowed, but it is still up 5% roughly year over year. So we have not seen a collapse in credit. Borrowing in the discount window has completely evaporated or gone down. So the stress in the banking system is gone. So the hard landing, recession is imminent type stories that were out there, I think those are gone for the time being. So you have to push out your timing for a recession. We have the U.S. economy growing more than 2% this year in our forecast now, on a Q4 to Q4 basis. So I know that's a little bit more bullish than the Bloomberg terminal suggests, the consensus, but that's where we see things here. And today's jobs report, I think, doesn't change that view at all.
Wow, that's so interesting. 2% growth year on year. I mean, if the two options here are no landing or soft landing, what's the kind of timeline that we see them play out?
Well, when I think about this, I'm always talking about the next 6 months, the next 6 to 12 months. So that will carry us into middle of next year. I realize for some investors, some viewers, you don't want that. You want to know the next 3 to 5 years, but nobody can provide that. So just trying to be realistic. I was talking to one of my colleagues yesterday. It's quite interesting. If you have for the next 6 months or so the no landing scenario, then it's possible the Fed has to do more. They hike even more, and then there are some ramifications for that down the road that could mean a more significant slowdown in growth, maybe some other financial market casualties. So when you think about these scenarios, they can evolve over time. But I think for the next six to 12 months, we don't have a recession. The Fed is, on hold or maybe hiking another time. Where I don't think we're going to see things evolve is a recession and rate cuts. And I think that's really important to take in because that has big financial market implications. We kind of were seeing that play out earlier this week with the flattening of the Treasury yield curve. The way I think about it, if the Fed is on hold just where they are, then the longer end of the Treasury curve can drift up just for that reason. Earlier this year, there was the expectation that the Fed would be cutting. And I think that underlied, a lot of the inversion in the curve. But if that's coming out, then a flatter curve makes sense.
Yeah, we kind of heard something along those lines this morning. Austin Goolsbee, the president of the Federal Reserve Bank of Chicago, was interviewed by Bloomberg's David Weston, and he kind of said the same thing. I guess the implication was they feel like they're making some good headway walking that fine line with holding inflation down while not pushing the economy into recession, suggesting that is consistent with kind of keeping rates where they are for a while. Does that seem reasonable?
Yeah, I think this is, again, great news for the Fed. The core inflation has come down. So on core CPI, we were 6.6 at the peak year on year. Now we're 4.8. But the unemployment rate is at 3.5, as we saw this morning, below where it was when the Fed started hiking. That's the best case scenario for policymakers. Improvement on inflation without having a downturn. But that said, doesn't mean that the Fed is going to be cutting rates anytime soon. Not with the unemployment rate at 3.5. And then even though we've seen an improvement in inflation is still well above the Fed's target. So stasis, holding here, might be how things play out. But I think that has implication for 2-year Treasury yields, but also 10-year Treasury yields.
We're looking at some important data on CPI, on PPI, Producer Price Index, next week. Talk me through your expectations there. What kind of number are you looking to see?
Well, the big thing for me is last month, so June core CPI was softer than expected, and I think very soft. So looking for that to pick back up month to month, maybe a 0.3% month to month percent change. So it could pour some cold water on the soft landing scenario if that does play out. But again, it ties back to our suspicion that the Fed is probably not done. And I think that would be the conclusion if you do see a pick back up in the core CPI reading. So that's really the critical report for me.
All right, Jeff, appreciate it. As always, getting your thoughts. Jeffrey Cleveland, he's a director and chief economist at Payden & Regal. We appreciate that. Where I really feel, or I have felt and continue to feel inflation is really at the supermarket. I mean, that is the big thing for me, and food in general, as well as gasoline. But I mean, it's real, and I'm not sure it's coming down. But
It's interesting. So they do in the CPI, and we'll get this number last week. It does look like food at home, so grocery prices have stabilized. What's really interesting is that restaurant prices are continuing to rise pretty rapidly.
That's why
but at least your grocery bill.
Yeah, I'm a big restaurant guy at this stage of my life, so maybe that's it. I'm still looking at the New York Strip at $58 versus 48 before, so I don't know. That's kind of my barometer. Let's head down to Washington, D.C. right now. Nancy Lyons has got World National News with us.
Thanks, Paul. Former President Trump is calling on the Supreme Court to intervene in his growing legal problems. In a post on Truth Social, Trump says President Biden has hit him with a barrage of weak lawsuits, even though it's the Justice Department that's issued the indictments. He also called it election interference and said the Supreme Court must intercede. Trump yesterday pleaded not guilty to criminal charges over his alleged efforts to stay in power after Biden won the 2020 election. Despite his legal woes, Bloomberg Washington political editor Wendy Benjaminson says Trump is still polling well with his Republican base.
I would think that the MAGA part of the party is about 30%. That is the part of the party that will vote for Donald Trump if, as he said, he shot someone on Fifth Avenue. That is the heart of the Trump support.
Bloomberg's Wendy Benjaminson says even Trump's Republican opponents are hesitant to criticize him for fear of alienating his supporters. Tennessee State Representatives Justin Jones and Justin Pearson are back in office. The Republican-dominant state House expelled the two Democrats back in April after they took part in a protest on the House floor in favor of stronger gun laws. They were demanding action following a mass shooting that killed 6 people at a Tennessee Christian school. The two were reinstated by local officials on an interim basis, but they had to win last night's special election to formally win their seats back. Lottery players are hoping luck is on their side tonight as they try and win the 4th largest jackpot in Mega Millions history. The top prize has risen to $1.25 billion after no one claimed the jackpot on Tuesday. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg with the Dow, the S&P, NASDAQ, all rallying. S&P, best level of the day right now. Stocks are rising, bond yields falling. After that mixed jobs report did little to alter bets on the outlook for Federal Reserve policy. 10-year yield at 4.07% with a 2-year 4.81%. S&P up 35 now, up 0.8%. The Dow up 264 points, up by 0.75%. NASDAQ up 1.1%. Bitcoin down 0.2%, 29,235 on Bitcoin. Gold up 0.5%, 1942 the ounce. And West Texas Intermediate crude up 1.6%, 82.87 for a barrel of WTI. Shares of Icahn Enterprises are plunging 23%. Carl Icahn slashed his company's quarterly payouts in half and pledged to, quote, stick to our knitting in another big move, acknowledging complaints raised by short seller Hindenburg Research earlier in the year. Amazon shares now up by 11% after last night's earnings report. Anurag Rana is with Bloomberg Intelligence, and right here on Bloomberg Markets, he told us he is very much focused on Amazon Web Services.
We just put a note out. We think next year AWS growth is going to be north of 20%. Market consensus still is about 14-15%. We think we should see a good rebound, not just in growth rate, but margins also.
And you can hear more of that conversation on the Bloomberg Tape podcast. You can download it wherever you get your podcasts. Amazon shares again up now by 11%. Year to date, this is a stock that is up 70.3%. Apple shares lower after earnings. Apple's market value fell below the historic $3 trillion level after the iPhone maker's outlook for the fourth quarter sparked worries over tepid demand for its handsets and other gadgets. Apple shares down now by 3.1%. Again, recapping a move higher for the U.S. equity market. The S&P, by the way, still on track for a loss of 1% on the week, but today, right now, up 35 points. The S&P higher by 0.8%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. We appreciate that. Simone Foxman, Paul Sweeney here in our Bloomberg Interactive Brokers studio in New York City. Plus, we are streaming on YouTube, so just head over to YouTube and search for Bloomberg Global News. Let's talk diversity and inclusion. This is Jobs Day. Let's put it in the context of diversity and inclusion. That remains obviously a challenge, seemingly an ongoing challenge for most of corporate America, and that certainly includes the financial services industry, the big investment banks. To help us kind of get a sense of where we are right now, Sandra Quince joins us. She's the CEO for Paradigm for Parity. She joins us via Zoom. Sandra, talk to us about Paradigm for Parity. Just start us off. What is it? What are you guys trying to accomplish?
Yeah, thank you so much for having me today. So Paradigm for Parity is quite simply a coalition organization that's focused on closing the gender parity gap and elevating women at every level of leadership in corporate America. We do this with a lens on racial equity. We provide our companies with a clear strategy and then we provide them with the key tactics, the programs, and the resources that they need in order to close the parity gap.
One of the interesting lines from this earnings report, Sandra, is that the participation rate for ages 25 to 54 actually fell for the first time since late last year, mainly because women were leaving the workforce. I thought, there's been this run-up in family formation, but, where do you see this coming from? I know you don't necessarily have all the nitty-gritty of the data, but what are the trends that you're seeing with the companies you work with?
Yeah, so certainly there are women that are making decisions to leave the workforce. The companies that we're working with are really focused on how do we keep women in the workforce or become a company that women can really see themselves thriving. And some of the things that companies are doing, quite frankly, is they are looking for opportunities to ensure that they're hiring women, but more importantly, that they're providing developmental opportunities to support women up and through the C-suite. So whether it's sponsorship programs or whether it's programs like our Paradigm for Parity Profit and Loss Leadership Accelerator program, whereby you're exposing women to other opportunities within corporate America, is critically important. And then last but not least, I think it's important that leaders create the right type of inclusive people leaders, so that, you know, whoever you're working for, that they understand some of the challenges and the issues and can really provide a workplace where all of their talent can thrive. And then companies that we're talking with are also looking at their benefits to ensure that they're meeting the needs of not only women, but their broader workforce.
Sandra, what are the companies that you deal with, what are they saying or what are they asking you in light of the Supreme Court decision on affirmative action?
Yeah, so a part of, you know, what they're saying is, number one, they want to stay the course and ensure that they don't, you know, reverse any of the progress that they've made over time. Some of the conversations that we're having is really stems around, you know, what do we do about our language? How do we ensure that we can continue to be a diverse and inclusive workforce, but ensure that we're bringing everyone along in this journey? So I think many of our companies are just taking a step back and looking at their language to be sure that that language is inclusive. They're also taking a look at their programs to be sure that while they have opportunities around women and those that are ethnically underrepresented, that they're creating the right processes in place to ensure that they are inclusive in that approach, that they are promoting all people within their organizations. So for many of our organizations, it's really around staying the course, but just taking a review of our processes and the language that we're using.
Well, I mean, staying the course, though, has kind of amounted, at least in recent months, to just not talking about diversity policies. I mean, that was certainly the case when you look through earnings reports around Pride Month after some dust-ups over particularly LGBTQ strategy, but particularly around the T element of that. I mean, is that the right way forward, is to just kind of focus internally and not speak as much about diversity policies, or is this kind of a temporary moment and you think we'll hear more going forward?
Yeah, so I think on some levels, right, for some organizations, the right thing for them to do may be to, again, just not sort of address some of the broader issues. But the companies that are really on the that are really making progress and have made progress over time, those companies are still speaking publicly about the fact that they are going to continue around their diversity and inclusion efforts, that they are going to continue to make progress because they want to reflect the clients and communities that they serve, which is certainly the right thing to do. We've even heard the same conversation coming from some universities as well, that while affirmative action may have been impacted, they can still make impact in their universities and create inclusive environments where they reflect the communities and in which they're located. So I really think that staying the course for companies can mean a couple of things, whether it means we're remaining silent, but for others, it means we're going to continue to speak out and speak out publicly around the work that we're doing and leading.
Childcare. What's the most common reason that employers cite for not providing childcare for their employees?
Yeah, so that's an interesting question. Many of the companies that we have that are part of our coalition that we mainly interact with, all of them have childcare. So there are very few that I've come across that are not providing some level of opportunity for families to care for their children. So I do think for some, though, that are not offering it, it could be the fact of affordability for their employee base. But there are tons of ways that you can provide childcare for your employees without companies having to pay tons of money for it, and provide opportunities, flexible work, for example, offering for assistance around for companies to be able to connect people to childcare opportunities or connect employees to opportunities or places to take their children so that they can come to work and know that their children are in a safe environment. So I think that on some level, there's something that companies can be doing that can be very cost effective.
All right, Sandra, really appreciate you taking the time to speak with us here on an important topic. Sandra Quince, CEO for Paradigm for Parity, P for short there. Sandra Quince, thank you so much. We're going to have more coming up. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
The bell can't come soon enough for Icon Enterprises, with shares plunging 23%. More on that from Bloomberg's Denise Pellegrini.
Well, Icon Enterprises, it's reporting a widening net loss, and it's announcing it's cutting its quarterly dividend in half, partly as a result of this. And all the pressure from short seller Hindenburg Research is also continuing. Carl Icahn telling shareholders the company is pulling back from its short bets and focusing on investor activism instead. But Hindenburg says in a social media post it remains short on Icon Enterprises nonetheless.
Thanks, Denise.
The request was...
The United Auto Workers wants a 40% pay increase over 4 years from Detroit's car makers. Bloomberg's Ed Corey reports.
The request was part of the UAW's opening proposals in contract talks with GM, Ford, and Stellantis. Along with the raises, the UAW has also said it wants cost of living allowances, improved pensions, and better treatment for temporary workers. GM says it plans to offer wage increases, but says overall the union's asking for too much.
Thanks, Ed. In a webcast earlier this week, UAW President Shawn Fain said he planned to ask the automakers for, quote, the most audacious list of proposals they have seen in decades. The current contract expires September 14th. And Apple shares are falling after the company issued a grim outlook for the fourth fiscal quarter. Investors worry demand for iPads and Macs will remain sluggish in what analysts say tends to be a seasonally tough quarter for the tech giant. Apple's valuation dropped below $3 trillion today. Right now, we have shares of Apple down more than 3%. Those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, Simone Foxman, Paul Sweeney here in the Bloomberg Interactive Brokers studio. S&P 500 up 0.8%. NASDAQ now up a little over 1%. So a nice move off the back of probably a Goldilocks type of jobs number we received this morning. There's something in there for everyone. So some folks reading it as something that might allow this Federal Reserve to be a little bit more sanguine moving forward as it relates to rates. Right now, let's head down to Washington, D.C. to go to Nancy Lyons because she's got world and national news for us.
Thanks, Paul. A day after being arraigned on charges of trying to overturn results from the 2020 presidential election, Donald Trump is calling now on the Supreme Court to step in. He writes on Truth Social, his opponent has hit him with a barrage of weak lawsuits which require massive amounts of his money and time to adjudicate. The latest indictment brought by special counsel Jack Smith alleges a months-long effort by Trump and a half dozen co-conspirators to keep his hold on the presidency. Well, the latest polling in the GOP race for 2024 could point to a vulnerability for former President Trump. Bloomberg's Nathan Hager has more from Washington.
The New York Times Siena College survey of caucus goers in Iowa shows Trump with 44% support, 24 points more than Ron DeSantis in the early caucus state, but it's less than the 37-point lead for the former president in nationwide polls. The survey suggests the Florida governor's efforts in Iowa may be having an impact. This poll was taken before Trump entered his not guilty plea in Washington yesterday. Nathan Hager, Bloomberg Radio.
Russian President Vladimir Putin's key rival, Alexei Navalny, is facing another 19 years in prison. A Russian court today convicted the opposition leader on extremism charges. Navalny is already serving a 9-year term on a variety of charges that he says were politically motivated. Navalny has exposed corruption at the highest levels of government and has organized major anti-Kremlin protests. 9 members of the U.S. Congress, 6 Democrats and 3 Republicans, toured the blood-stained and bullet-pocked halls of Marjorie Stoneman Douglas High School in Parkland, Florida today. Few people have entered the building since the 2018 mass shooting that killed 14 students and 3 staff members. A short time after their tour, a ballistics expert fired shots in the school as part of a reenactment of the massacre. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Now back to you, Paul and Simone.
All right, Nancy, thank you so much. We appreciate that. Simone Foxman, Paul Sweeney here. Here we go. On the Bloomberg terminal, an article by Joe Constance. Here's the headline. Fully remote new hires show 18% drop in productivity. That's according to a study. What do you think?
Okay.
Now, let me do this. I don't know what you call it, a sub-headline? What do you guys call that? Okay, sub-headline. The paper adds to a growing body of research that points to productivity costs of working from home full-time.
Yeah, but I look at the third and beyond paragraphs.
Okay.
Talking about that these
I
are...
usually go to the first 2.
Well, I read those too. Okay. But newly hired data entry workers in India, that's who they're polling. Okay. So these people have not been at the office ever. Okay. They were newly hired and randomly assigned. That also kicks it for me.
Okay.
Because, I don't know, I'm not great at working remotely. I'm just not that productive. In most cases, dear bosses, please remember, sometimes I'm productive. But I'm not that productive in most cases. I'm the kind of person needs to be in the office, even if I don't have to. I think people choose what's best for them.
Right. And so I think that's kind of where corporate America is kind of, I don't know, evolving into. And I was just shocked, at how productive this economy was, workers were. I remember thinking at the very beginning of the pandemic, as everybody was being sent home, I'm thinking back to my trading days or something. Like, how could I trade from home? And I mean, I just couldn't even conceive of it. Then the next quarter, Wall Street puts up their biggest trading quarter ever.
Yeah.
It's just, so.
But maybe that was a function of the market. And I know, because I know that I've spoken with my former print colleagues as well. And we just say, it's nice to be talking to people, hearing the conversations that others are having on the phone, and then, it brings you together. But
well, my personal thing is the more back to work, the better. The more back to the office, the better. I don't know if that's 5 days or 4 days or 3 days. I'll let the smart people figure that out. But got to be in part-time, I think. I don't know. We'll see. It's going to evolve. This is Bloomberg.
City for our viewers worldwide, I'm Katie Greifeld. Bloomberg Real Yield starts right now. Coming up, a mixed jobs report sends yields sharply lower, delivering some relief after a brutal stretch for long-dated bonds following a shock U.S. downgrade and boosted Treasury auctions. We begin with the big issue, making sense of a wild week.
It's the job report that has something for everybody. You've got a solid economy.
The U.S. economy continues to power through. We do query whether the payrolls numbers are telling the real story.
It's an economy that's in good shape, but that is moderating.
There's still risks out there.
The bond market.
The U.S. Treasury market isn't like other bond markets.
We're experiencing a wrecking ball.
This was the year of the bond, right?
That 5 to 10 year part of the curve is the most sensitive part.
Are people really going to be willing to accept a 4% 10-year note?
You've had a very rich 5 to 10 year part of the curve.
It seems so high to us because it's been so low.
You wonder, what is the long end doing for you? It's hard to convince people to go towards the long end. Long interest rate exposure is becoming questionable as value.
Joining us now, I'm thrilled to say we have RBC's Blake Gwynn and Earl Davis of BMO, both from Canadian banks, which is a little bit fun. And Blake, since you're on set, I'll start with you. And it's hard to know where to start on a week like this one. So let's go right to the price action, because if you look at 10-year yields, they were up, 23 basis points from Monday through Thursday, only to fall 11 basis points or so today. How do you make sense of that kind of volatility in benchmark Treasury debt?
With these big moves, I always like to separate things out into two kind of pieces. A lot of times you have the fundamental piece, which is good for the first, 1/3 to 2/3 of the move. And then after that, things become a little bit frothy. And I think we crossed that line at some point earlier this week. I think there's some very good reasons that yields have moved higher. But I also think that at some point you cross some technical levels, volatility starts to feed on itself, and that really pushes higher. And so it's not really surprising to me that we're giving some of that back today. But I still expect we're going to come out of this with steeper curves, higher yields overall.
And could you quantify that? When we talk about higher yields, if I think about for 10-year yields, for example, we got up to above 4.30 back last fall. Are we going to revisit those highs?
It's certainly possible. I think what's really going to be key over the next week is just seeing if we drop back below that 4% level, if this becomes kind of a new floor, or if we drop back into that range that I think we were pretty comfortable with, back in July, with 4% being kind of a ceiling. So I think seeing what happens this week and where we fall is going to be very telling. But I will say, this whole thing kind of started on a supply story, I think. I think that was one of the major catalysts. And I think if you look back over the last year, yields were really driven entirely by what the Fed was going to do over the next meeting or two. That was responsible for most of the volatility and rates, the curve. And I think we are moving into, on the eve of kind of transitioning into a bit of a different environment where with the Fed on hold, with them not likely to cut until mid-2024, some of these other things that have been on the back burner are going to start to become more important. Supply is one of those. We've had very low supply for a long time. Monday, when this thing really started to kick off, we got information from Treasury that kind of shocked markets and told them there was going to be a lot more supply. That's coming against the backdrop of weaker demand from banks, from overseas. So I think this idea that term premium and some of these other things that tend to drive bond yields coming back and taking some of that volatility away from just being entirely about the Fed path, I think that's what we're entering into, and that's why I think it is possible that we hold on to these higher yields for a while.
Well, Earl, let's talk more about supply, because of course we got the refunding announcement this week, and it was bigger than expected. $103 billion of longer-term securities sold next week. The expectations, I believe, for $102 billion. How much does supply actually matter in the world's biggest bond market?
Supply is 1/3 of the equation. The other side that matters is who's going to buy the supply. And over the past 2 years, we've taken out two of the largest buyers of the supply. One of that's the federal government through QE. We no longer have that. And then you take out largely the second largest buyer, which is Japan, because now they can buy domestically. So what happens in that environment is rates have to find a new level to clear. They have to reprice to the next marginal buyer. And we do believe that is at higher yields than we saw at the highs of last year.
And you do have, some big names coming out saying that they're outright shorting the long end of the curve. I'm talking about Bill Ackman specifically here, the Pershing Square chief, saying on Twitter, or X if we want to call it that he's short in size the 30-year Treasury, and he had a myriad of reasons. But Earl, when you say that yields probably have to reset higher from here, is there enough conviction there to actually short this market?
Well, yeah, there's actually one important tailwind that adds to shorting the market. Because of the inverted yield curve, when you're short the market, you actually make money every week and the market doesn't move because of the negative carry, which is positive if you're short. So I think that's a significant tailwind that allows individuals of size, institutions of size, to feel comfortable being short at these levels.
And where do you go on the other side of that? Because, for example, we've also heard from the likes of Elon Musk actually replying to Ackman on Twitter, or X, I keep calling it Twitter, saying that T-bills are a no-brainer here. When, if you do short the long end, does that marry with maybe staying in cash here?
You know what makes total sense to me? Cash has become a new asset class, basically. Before we looked at cash as where to park your cash. Now you can look at cash as where to invest your cash. And you know what? T-bills make a lot of sense at this point in time because you have the ability to go longer when you want to, or to go into risk assets when you want to. It provides you a lot of flexibility at a 5% rate. So I agree with that.
And Blake, it's interesting. I feel like before this week or last week, the conversation around cash had really been about opportunity costs, that you don't want to stay out in cash too long. Now it feels like the conversation has changed again, and people are saying that cash is pretty much just in a sweet spot. Where are you currently on cash?
Look, the yields are still very attractive, and I think if you look at how markets have taken down, this big slug of bill supply, I think last time I was here we talked about the coming wave of bill supply. Markets have done very well with that. So clearly people are still interested in buying that cash. Still a lot of money to be put to work. We haven't seen those cheapen as much as I think some people had been expecting. I think there's still a lot of appetite for that cash. We have a lot of bill supply coming too, by the way. When we got that surprise on Monday, it wasn't just about coupons. We also, it implies a very big increase in bills as well. So a lot more vehicles there coming online. Now maybe we see that cheapen, but I think markets are going to continue to take that down. I mean, if you look at where the overnight repo facility at the Fed is, it's come down, but it's kind of, started to basically go sideways at around 1.7 trillion. That's still a lot of dry powder that's sitting at that facility that could come out and buy these short-term cash-like instruments. So I still think, that stuff stays pretty well bid.
And where is the demand coming from? Because it was interesting hearing Earl saying that, we've removed two of the biggest buyers for outright Treasury bonds, one of them being Japanese buyers. Where is the demand for bills coming from?
Well, I think to a big extent, it's people like myself who are earning, 10 basis points on a bank deposit not too long ago and see these kind of yields that are available at the very front end. Maybe it's not the bulk of kind of your investment strategy, but as far as getting that additional return and seeing the kind of numbers we see on these money fund returns at this time compared to where they've been for the last few years, I'm not surprised that people are continuing to move out of lower yielding instruments into those. We're not talking about people coming out of high yield securities or bonds into bills. It's really coming out of bank deposits and other places like that.
And, the conversation we're having so far, we really haven't talked about the Fed that much, which is amazing to me, Earl. And like you said, I mean, we really are focused on supply here, but when we focus on the fundamentals of this economy and what the Fed will do, obviously we have a big data point next week in the inflation report. And if you take a look at the expectations, actually, it's for a little bit of a reacceleration, at least on the year-over-year number. A lot of that, of course, comes down to base effects. But what does that potentially mean for the Federal Reserve? And is that reacceleration a dynamic that you expect to continue?
Yeah, you know what? I start with the base case. The Fed, central bankers don't want to hike rates. I think that's pretty obvious. But I think they will hike rates, and they'll be forced into that through the data. And the data has shown extreme resiliency, not just the economic data, but look at the earnings results, right, that are coming out. There's no earnings recessions. Margins are robust, and they're able to maintain that. So that tells me even though we are restrictive, we're not restrictive enough. And that's the key thing that the Fed's looking at. So I do think the base case, they want to wait to see to hike. I think they will wait. There's maybe a couple more this year, only because they don't want to. But that's why you get us making new high rates on 10s and 30 years. Because as I said before, demand's 1/3, supply's 1/3. The 1/3 I did not talk about is risk premium, inflation risk premium. And if the Fed doesn't hike enough, then that just goes into the longer term as a risk premium. So, and that's what we're anticipating this year.
And Earl, to your point that the Fed doesn't want to hike anymore, we actually heard from Atlanta Fed President Raphael Bostic earlier saying that he sees no need to hike anymore, that the labor market is slowing, and maybe they don't want to hike anymore. But what about the balance sheet? What about quantitative tightening? What do you think sort of the urgency at the Fed is when it comes to the balance sheet?
Well, as they said, quantitative tightening is unknown, right? It's the first time we're going through this. So yes, you could theoretically think it impacts the economy, but they don't know. And at this point in time, especially because of financial stability concerns in the background, as we saw in March and whatnot, they don't want to add another unknown to the equation. So I think they continue as is no matter what happens, tell you the truth, because they don't want to add that unknown or increase the possible financial instability in the background.
And Blake, we don't have a ton of time left, but I am curious to hear your thoughts, not necessarily on how many more hikes we're going to get, if any, but the question about cuts. When do you expect to see the first rate cut from this Federal Reserve?
So we've pushed those out into second quarter of next year. So we think they'll be on hold for a while. And I should say the path of those cuts, we don't see a sharp pace of cuts. This is a gradual adjustment process back to something closer to neutral, not a very urgent need to get back below accommodative levels.
And is that due to a recession, or is that just to get back to
No, this is more falling inflation, making the real yield passively getting tighter and tighter. So they're going to need to kind of counteract that as inflation falls. The real side of the yield, that's the name of the show, that's going to continue to go higher. So I think at some point they have to start pulling those rates back so that the real yield doesn't get tighter and tighter.
Well, on that real yield note, it's a good place to end it. Blake Gwynn and Earl Davis, thank you both so much. Really enjoyed this conversation. Up next on Real Yield, it's the auction block. Wells Fargo returns again for another sale. This is Real Yield on Bloomberg.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the auction block, where Europe was a bit quieter than here in the U.S. Today, we had another day of zero sales in the region, and the whole week in total saw just one deal. We've now seen 23 zero days this year. Over here in the U.S., it was a different story. Weekly volume topped $34 billion, led by another sale from Wells Fargo, the bank with 3 sales in recent weeks. And in high yield, supply hitting $100 billion for the year, jumping by over 40% year over year. Still, it's the slowest for new issuance since 2009. Meanwhile, Citi's Richard Zogheb says that Fitch's U.S. downgrade presents potential benefits for AAA company debt.
I do think those companies benefit because I think if you look back, a few years ago when we had the European sovereign crisis, what you saw there is a number of investors replaced sovereigns in their portfolio with multinational safe corporates. And I think you could see a little bit of that happen here as well. Unfortunately, the group of companies is small enough that you can't, there's only so much you can do.
Joining us now, we have BlackRock's Amanda Lynham and John Sheehan of Osterwise Capital Management. And Amanda, I'll start with you because most of the conversation around the U.S. downgrade has been related to the Treasury market. But when you think about the corporate credit markets, what potential ripple effects could there be from that downgrade?
Hi, Katie. Thanks for having me. I think really what we're seeing is this kind of combination of news flow over the past 2 weeks, whether it was the Japanese tweak to yield curve control or the downgrade or the Treasury supply or the better economic data, really kind of reinforcing this higher cost of capital environment that we're expecting to be front and center for the corporate credit market, specifically the speculative grade issuers that are more sensitive to those borrowing costs. And as we've seen long end rates move higher, it's really reinforced that view. I think the other really interesting thing that wasn't talked about as much this week was the recent data on bank lending and the pretty significant contraction there. And I think one of the things that we've been emphasizing is, one, the read-through to economic activity might not be as direct in this cycle relative to past cycles. So it's been well telegraphed that bank lending conditions haven't been this tight except for previous recessionary episodes. But the big difference between now and those periods has been the significant growth of the private debt market and firms' ability to diversify their funding sources. And so we think as that contraction in bank lending continues, which the survey made clear that it will, we think that that opens up an opportunity for private debt to expand its addressable market and increase its pricing power. But kind of bringing it back to the corporates, I really think that there's not really relief in sight from a cost of capital perspective. So then you have to pivot to, well, what's the second order implication? It's dispersion and it's an uptick in defaults, which we expect. And I would say that's true even without a recession.
And it's a good reminder, we did get the Fed's Senior Loan Officer Opinion Survey on Monday. And John, that feels like actually a decade ago. I kind of forgot about that. And I mean, Amanda laid it out well, that it did show a continued tightening, that credit is becoming less available. When you think about the investment grade market from just a sector standpoint, where does that leave you on financials, for example?
Yeah, we think the investment grade corporate market is showing signs of late cycle. Valuations are pretty stretched right here. We hit a tight last week of 112 on the index, the OAS of the index. We sit right now just at about 119. We bounced off of 165 3 different times this year. So we think the market's priced for perfection. The big banks are benefiting from higher rates. So, if you look at net interest margins in all the earnings releases this past cycle, they all showed a pretty significant uptick. If you can put money on deposit with the Fed at 5 1/4, that's really good. I met with one of the largest banks in Spain recently, and they're paying 0 interest rate on 40% of their deposits. So despite what we heard through some of the regional banks and the Silicon Valley situation, banks are still paying significantly lower than they can earn with the Fed. So you're seeing that flow through to net interest margins.
And you're seeing that flow through into money market mutual funds, which are at another all-time high in terms of assets. But Amanda, you had mentioned that you see this as a tailwind for private credit. Can you quantify that? How big could that market get?
So the global private debt market is $1.5 trillion in AUM, and so for context, that's slightly larger than the U.S. high yield bond index and the U.S. leveraged loan index. So there's pretty significant scope for growth in that market. We think, one, because of this opportunity to expand the addressable market that we outlined, but two, when you think about and just using data from Preqin, for example, investor allocations to private debt relative to more mature asset classes like private equity, there's probably a lot of scope for private debt allocations to grow there, specifically when you think about investors that do asset liability matching and are looking for kind of long-term investments. So think insurance companies, pensions, endowments. And so we do expect a pretty significant growth backdrop there. I think in the near term, what's probably most interesting for corporate credit investors, however, is that in this backdrop of elevated inflation, and Blake and Earl mentioned in the previous segment, kind of the Fed perhaps not being in a rush to cut rates, we would agree with that. So in this environment where you have a higher cost of capital, perhaps below trend growth, a challenging growth inflation policy mix, you really want to protect yourself with structural protections and credit selection in an environment like that where defaults are picking up broadly, we think. Not to extreme levels, but a moderate uptick. And I think private debt probably lends itself well for investors to introduce that granularity into their portfolios and those, in some instances, those structural protections, which we do like in the current environment.
So potentially the stars aligning for the private debt market. But John, I want to go back to the corporate credit markets, especially when you look at just overall investment grade and high yield spreads. There's really been not a lot of action. The volatility is very, very low, which is striking on its own. But then you consider what's going on in the Treasury market, which has been a little bit of a basket case. When does volatility return to credit markets?
Yeah, the credit markets are very dependent upon liquidity. So, if you look at the growth of the investment grade market, it's grown fivefold since 2006. If you look at the balance sheets provided by market makers, they've actually shrunk in that time period. So when you do hit periods of illiquidity, that's when you see spikes in credit spreads. You can see it on the graph right there in 2020, in March of 20. More liquid products like treasuries and mortgages tend not to see that heightened volatility because it's a higher quality asset and you have more balance sheet from the market makers committed to providing liquidity in those arenas. So that's part of the reason why we feel like, at 120 on the index right now, you're really not getting paid for the, risk of that type of liquidity event that you could see in the marketplace.
Well, Amanda, we only have about a minute left, but come in on that point because you have seen the dynamics flip a little bit, whereas the Treasury asset class is more volatile than corporate credit. Does that potentially make high-quality company debt a better hedge than Treasuries, for example?
I think probably for the corporate sector, the most important thing is this upcoming wall of maturities and the refinancing risk that needs to get flowed through. And to your point, Katie, high yield spreads in particular have been really snug relative to some of the volatility that we've seen in other asset classes. And we think the very low supply figures have been a big part of that. You noted that we're starting to see an uptick in supply, but from a historical context, supply is really light. And 2022 was a record low level. So there's been kind of this drought in supply. The one thing that I think is really important for corporate credit investors is that in the leveraged loan market, those higher financing costs are being realized immediately because the borrowing costs are moving higher in tandem with the policy rate. In high yield bond land, that hasn't happened yet, but we do expect that to flow through. And as those borrowing costs flow through, as the maturity walls move closer, then you will start to see some more volatility in high yield spreads and some widening. All right, Amanda Lynham and John Sheehan, thank you both so much. Really appreciate it. Still ahead, the final spread. The week ahead, another key inflation print on deck. This is Real Yield on Bloomberg.
large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
This is Bloomberg Real Yield. Time now for the final spread. The week ahead, coming up, earnings on Tuesday, UPS, Rivian, and more. Thursday, U.S. CPI, another round of jobless claims, and then Friday, PPI. But let's talk about that CPI print. Going to be the one to watch year over year. Expected to see a slight reacceleration, 3 to 3.3%. We'll keep an eye on that. But from New York, that does it for us. This was Bloomberg Real Yield, and this is Bloomberg.
Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's for the Fed to respond to it. And this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, the big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy. But man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching. You do not want to miss this story.
He's there, the kind of upside.
I'm John Olifant. Welcome to Bloomberg Markets.
And I'm Sonali Basak. Matt Miller is off today. We're going to get a quick check on the markets first because we have the S&P now inching just a little bit higher, but I don't want that to confuse you because this is a down week for the S&P 500, actually the first in about a month. We are only up about 0.5%, about 0.6%, and the NASDAQ 100 also up almost 0.8%, despite some choppy earnings, which we'll get to in a minute. I want to talk about this 10-year yield, though, because really the movement is there with a stunning 10 basis point drop. You're looking at the week ending for the 10-year at about 4.07. That is where we were just about Wednesday. And same for the 30-year yield. You're watching the yield cooling a little bit, just about 6 basis points. But remember, we are still more than 20 basis points up on the week. Just a stunning move at the long end of the curve. I want to flip up the board and look at some earnings here because I first want to take a look at Apple here, really taking a beating in the market with more than a 3% decline. That is the worst drop we have seen since January. It is on its longest streak of quarterly sales slumps for the iPhone maker in about 2 decades there. But I also want to talk about Amazon because that's such a positive story there with not only revenue increase, a slowdown in spending for the e-commerce giant, and that is pushing its shares up more than 10%. That is the biggest jump we have seen since at least November of last year. Coinbase now almost flat on the day, only down about 0.2%, 0.3%. This is a stock that's been volatile all day after market yesterday, after reporting results, beating analyst estimates. However, you do have Coinbase here with assets just under where Wall Street had expected, plus a lot of uncertainty about that stock after a big rally this year so far. Icahn Enterprises now. This has been a big story on Wall Street for Carl Icahn's firm, down the most it's been in history after slashing its dividend, John, by half.
A helpful breakdown of many of the micro stories, if you will, on a macro day, Sonali, when in North America we've been looking at the jobs report, obviously in the United States, but also here in Canada, where we saw job losses in the month of July, 6,400 jobs lost. The expectation was you'd see a gain of 25,000 positions. The unemployment rate ticking higher for a third straight month. And so now that we've got 2 months out of the last 3 with negative jobs, a lot of people wondering about the impact on the economy, what the inflation story looks like if interest rates have been climbing as they have. That being said, Sonali, you've got wage growth that is reaccelerating, and I think that's why on both sides of the border we've seen mixed jobs reactions, if you will.
Certainly mixed job reactions. And talking about those reactions is BlackRock's Rick Reeder, who discussed that report earlier today on Bloomberg TV.
You've got an economy that's slowing somewhat. You look at this number, you look at the hours worked coming down a bit. You look at the 3-month moving average versus a 6-month versus 12 months coming down a bit. By the way, you look at temporary hiring coming off. So, it's an economy that's in good shape, but that is moderating. And I'm in the soft landing. I'm in fact, I'm in the no landing camp in that, I think the economy's in pretty good shape. But at the margin, this is indicative of an economy that is slowing down. Same thing you've seen in the earnings this quarter.
All right, well, let's get some more perspective. Bloomberg Economics Chief U.S. Economist Anna Wong joining us for the conversation. I mean, Anna, if you were going to characterize the economy right now, how would you put it?
I would say that soft landing optimism is overdone, and that I think today's the jobs report in the U.S. is sort of a wake-up call. I see today's jobs report as unambiguously turning into a softer side. A lot of attention is on the higher than expected wage growth, but when you look at it, the reduced hours worked also means that the total weekly hours earning is only growing by 0.1%. So while people are paying more per hour, they're working less. And usually that is the early signs of a downturn. It's only usually in the first or second quarters after a recession started that mass layoffs happened. And, I just saw what happened to Canada. I think that a lot of the rest of the economies in the world are also heading toward the direction that Canada is heading. And I just don't see the U.S. being decoupled from the rest of the world in terms of slowing growth.
And especially given the wage growth in particular, what do you think that this means for any potential future rate hikes?
Not much, because the Fed really cares about the employment cost index, which was released last week, and that actually showed a pretty sharp moderation in wages, and especially private sector wages. It's coming down from high 4s to now 3.7 to 3.9%. I think the Fed will discount the average hourly earning data we saw today, which is highly susceptible to revisions in the past.
Anna Wong, thank you so much for your time. Now we're going to talk markets with Peter Krause, the chairman and CEO of Aperture Investors, kind of one of the longest standing asset management veterans on Wall Street. Peter, thank you for joining us because, you know, I keep on bringing this up every time you do join us, that you were so early to target inflation.
Yeah.
And now you have a lot of warnings out there, even Larry Summers saying that you could still see an inflationary spike. And so do you think that the Fed's job is anywhere near over, given those uncertainties we've seen both in wage growth and oil markets and anywhere else you can see further price increases?
Well, you're nice to say those kind words, Sonali, so thank you for that. Look, I think part of the problem of talking about this period of time is we have to talk about the time horizons that we're focused on. So if you want to talk about soft landings, you know, for the next 2 months, 3 months, it could be a soft landing. But if you're going to talk about the next 6 months to 9 months, the Fed actually has been aggressively raising rates to slow the economy down. We know the economy is going to slow. And what we don't know is what the long-term inflation rate is going to be. We know we're going to take down the short rate. That's already come down, but it's not to where the Fed wants it to be. But the implication in the Treasury market is the long-term inflation rate is 2.2%. And that's risky, because I think that long-term inflation rate is too low.
Talk a little more about especially that long-term rate, because that tremendous move we've seen in the 30-year, more than 20 basis points in a week. If you were here yesterday, it would have been 30 basis points.
Yeah.
What is that telling you about the direction of travel?
Well, there's two things going on there. As you know, as you well know, that there's a significant amount of borrowing that's going to take place by the U.S. Treasury, and that's obviously from a technical point of view affecting long-term rates. But this long-term expectation question is also at play. And I think that the market's going, or investors are going to come to the point of view that 2.2% is probably Goldilocks, and that it's more like 2.5 to 3. And that may not sound like a lot, but you know, you're going to add 50 basis points to even 100 basis points onto the very low long-term rate. That's a big change. And I think the market hasn't taken that into consideration yet.
Peter, how do you think about the growth conversation, the economic conversation, at a time when we are also having a conversation around new technology, disruptive technology? Even within the stock market, it's no secret that the lion's share of the gains have come from companies that are betting on an AI future.
Well, it's a very good question. And what's happening is that AI effect, which is replicated in many different companies, people are saying, well, that's a growth trend I could bet on. That's a growth trend I can get behind, because that's sort of extraterrestrial to what else is going on in the economy. So that's why you see the values for AI companies accelerating as much as they are, because growth elsewhere is uncertain. And so the money is concentrated on buying that AI effect. That's not going to be long-lasting. It's not that it's going to go down or blow up, but the acceleration of growth is going to be a lot slower. So when the economy reaches a slower speed and we get to either a modest recession or realize that growth has actually gone into zero or negative year over year or month over month or quarter over quarter numbers, then investors are going to start looking into 24, 25 and saying, I'm at the bottom. And you know, if you look at consumer companies, you sort of see that. There are some consumer companies where investors have seen significantly lower growth rates sequentially quarter over quarter, and they're reaching the point at which the future quarters look like there's growth. So even though we may be in the slowing period and this higher inflation rate and this higher interest rate cycle, and where the Fed is taking enormous amounts of liquidity out of the market, those consumer companies actually look, from a longer term point of view, very attractive. So I think AI is of the moment. That's where the more sustainable growth looks, but that's going to eke out into other companies as investors look, you know, throughout the market.
And then what about what might be not obvious to us today, but perhaps beneath the surface, whether it's in the credit market? You know, it wasn't that long ago that we were worried about turmoil in the banking sector. And I wonder how closely you're going to be watching that part of the equation, depending on where the economy goes from here.
Look, the credit complex is in a, I think, very challenging position. Nominal growth or inflation has helped companies increase their prices and grow their revenues and offset some of the increase, but they haven't really met the refinancing demands that their existing capitalization structure requires. And when they hit those refinancing demands, we're going to see some cohort of companies not be able to refinance. And we're already seeing some effects of that now. The credit spreads widened 2-3 months ago, and now they have come back in. They're probably a little too tight from my point of view. Certainly double Bs and investment grade. On top of that, don't forget the real estate cycle. So while banks you may not have another SVB or Signature Bank or, you know, that kind of crisis, you are going to have continued pressure on bank balance sheets. First of all, the Fed and the OCC are being much tougher on capital requirements. So lending is going to slow down. You're going to see some effect of losses on bank balance sheets from commercial real estate. You're already seeing commercial real estate hit the wall in terms of refinancings. That's going to also constrict loan growth.
Peter, you know, you mentioned kind of these tights that you're seeing, and especially high yield credit, investment grade credit, that is the same. At what point do you think investors will get burned? Where are they being way too sanguine, given some of the stresses that you have been highlighting?
Well, look, the credit market doesn't usually react to these things until there's an event. So that's sort of the unfortunate aspect of it. It's possible that investors will start to look at the tightness of double B spreads and say, I'm really not getting compensated, and start to sell that. But until you actually see an event that's big enough for people to notice, the spreads probably don't move.
All right, Peter, great perspective. Thanks very much for your time today. We do appreciate it. Peter Krause, Chairman and CEO of Aperture Investors, joining us as we watch the road ahead. Coming up, Tanger Outlets moving higher today. Here's a company that benefits from consumers spending, and the shares moving higher after stronger than expected results. And we're going to talk about the health of the consumer and the real estate market with its CEO next. This is Bloomberg.
So Fabian, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com webinars.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Only on Bloomberg TV and Radio.
This is Bloomberg Markets. I'm John Olifman with Sonali Basak. Time now for our stock of the hour, and we're watching shares of Tanger moving higher right now, actually sitting at the highest level since 2017. The Real Estate Investment Trust, known for its outlet store properties, reporting some well-received results. Sonali, consumers still shopping. Retailers are also showing a willingness to pay higher rents right now, and that benefits a business like this one.
It sure does, and we have Stephen Yalof, who is president and CEO of Tanger Factory Outlet Centers, with us now. Stephen, when you take a look at what is happening in terms of rents, in terms of consumer behavior, the question I have is, can you keep it up, or are there still more cracks under the surface here in terms of risks to your outlook ahead?
Well, we're very optimistic about our outlook. And if you've taken a look at the progress that we've made in the last 2 years coming out of COVID, we felt as though our real estate was undervalued. So we put a team together, we built a strategy, and that strategy was to execute to growth. And that revenue growth is coming mainly from pushing rents. And that's something that we've had a great deal of success. One of the measures that we use is our OCR, occupancy cost ratio. That's how much the retailers pay as a percentage of their sales. And for us, we set a goal of pushing that OCR to historic high levels, which were back in the 10% range. We started out low 8s, we're up to 9 this quarter we just announced. So we still think we've got plenty of headroom to continue to push the revenue.
Another interesting statistic about your results are that almost a quarter of the tenants are new to the portfolio. Are there different types of tenants that you're bringing on than in the past?
Well, we're changing the look of what a traditional outlet center was. So in the past, it was really a power shopping experience, a lot of brands selling direct to the consumer. And now what we're finding is the customer that's coming to shop with us is looking for a more rounded experience. They're looking for better food and beverage, better amenities, better entertainment opportunity when they get to our shopping center. So a lot of the leasing we're doing right now is catering just to that, to getting the customer to come with us, stay longer when they do, and then ultimately spend more money when they're there.
And we should point out, Stephen, that's not just which retailers you're working with. I mean, I even heard on your conference call talking about the electric vehicle revolution. I mean, the whole design of how people are getting to your properties is a consideration as well.
Well, yeah, I mean, it's the future of retail. Our vision statement as a company is to use the customer experience and the customer's information to inform the future of shopping. And what does that mean to us? We took a look at what happened coming from COVID. The customer wants to maybe buy online and pick up in store, or the customer wants a curbside pickup. But the customer, like I said earlier, wants a better food and beverage. Well, that's how we've designed the center. We're going to actually open up a new shopping center in October in Nashville, Tennessee, 290,000 square feet. We just announced with less than 90 days till opening, we're over 95% leased. 15 of those retailers in that 60 retailer shopping center will be brand new to Outlet or new to Tanger. And more importantly, about 20,000 square feet of the mix will just be food and beverage. So we're listening to our customers. We're bringing them exactly what they want. And we know they're going to pay us back with many visits and a lot of sales when they get there.
Well, it's interesting. I mean, even in Canada, you've had a longtime partner in RioCan, and we spoke to their CEO, and they feel that their business mix has been relatively strong. I guess I go back to Sonali's first comments. You've got an expansion story. What is it that maybe some are missing, at least about some parts of the commercial real estate market right now?
Well, what's in favor right now, especially in an inflationary time, is value. We are a value shopping experience every day, which means that you can get your favorite brands, top brands, national, international fashion, accessories, apparel, athletic fitness, every single day, shopped in a lifestyle environment. And what that means is each of the brands have their own store. So you're not going and buying some curated assortment from a multi-brand retailer. You're going into a store and being able to shop from the entire lifestyle of their assortment. So brand fans who love a particular brand will go into that store, and the entire wall to wall is that brand, that product, and most importantly, on sale every day. And that's what's great about this outlet channel. And let's go back to the 95% lease statistic that I gave you on Nashville. I mean, that's almost unheard of for a new center. And the reason why it's happening is because these brands understand how important it is to have outlet as part of their omni-channel experience.
Stephen, I want you to take a listen real quickly to a conversation we had yesterday with Dan Chung, the CEO of Aldra Management. I think it is a really good example of just how negative the tone out there is for real estate in general. Here, let's take a listen.
We're still bearish on things like real estate, in particular valuations around real estate that got driven up so much over the last 5 to 7 years with falling interest rates. We don't think they've adjusted and corrected for the new interest rate environment. Secondly, you have to look at the derivatives of real estate, so construction, suppliers to it.
Now, I know you're bucking the trend here, but you also have had more than 2 decades in the real estate industry and retail, consumer, malls. People are really worried about it out there. So what are the things that you think the industry might still fall prey to? What are some of the pitfalls you are trying to avoid?
Well, I just, in listening to his narrative, real estate's a big category. We are in retail real estate, and right now, retail real estate is a darling. And it's proven if you take a look at the other landlords, developers, REITs in our sector, they all seem to be performing. So I'm sure there's categories and classifications of real estate that aren't performing as well as we're performing right now. So if we stick in the retail business, and particularly in the outlet business, the statistics are showing the retailers are there. They're signing up for longer leases. We announced today our rent spreads, and a rent spread's an indication of what a retailer is willing to pay in the case of a renewal rent spread to stay in a store that they already have. But in the case of a re-tenanting, it's the new rent that a retailer's willing to pay. We're getting about 30% on average increase from the prior tenant to the new tenant. And in the case of renewal, and that's the clearest indication to me, because when a retailer renews, they're basically voting and saying, I've been in that shopping center, I want to stay there, and I am willing to pay more to be there. And in these instances, or the number that we reported today was a 12% increase. So retailers are willing to renew in our shopping centers and pay 12% more than they were paying previously in order to stay there.
And the market responding to that, as we've seen with your stock price today. Stephen, thanks for your time. Appreciate it. Stephen Yalof, the Tanger CEO, joining us on the situation with his business these days. Hey, the situation in the cryptocurrency trading world has been getting attention recently. Coinbase asking a court to toss its SEC suit following the Ripple ruling a few weeks ago. On a busy day for that company. We'll get more details coming up. This is Bloomberg.
Connection lost.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that
here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Time now for today's For What It's Worth. How about 39%? That data point is tied to Coinbase. It's the percentage of transaction revenue for Coinbase that comes from Bitcoin, at least in the latest quarter. Coinbase benefiting from a rebound in crypto prices in the first half of the year as Shonali also navigates these choppy regulatory waters.
Absolutely, and today Coinbase asked a judge to dismiss an SEC lawsuit against it, pointing to a recent decision by another judge who ruled that Ripple Labs' XRP was not a security when it was sold on exchanges. Last night, I spoke to Coinbase CFO's Alicia Haas about the regulation's impact on the business.
There was a flight to quality. There was a flight towards Bitcoin and Ethereum. We are definitely seeing the impact on some of the longer tail of crypto assets at this time because of the regulatory headwinds. However, we will work through that, and I think that we are excited to share with the market tomorrow our motion to dismiss on the case that the SEC has brought against us, and really share why we think these assets can be traded in the U.S.
I'd like to tell you, John, that market doesn't know how to feel about the uncertainty around Coinbase, but even with the volatility today, it's still up 154% this year.
And the industry looking for clarity. That seemed to be the message from Coinbase, right? We'll keep watching. For Shonali Basak, I'm John Ehrlichman. This is Bloomberg.
Top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. Mars studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
Welcome back to Bloomberg Daybreak here.
Good morning, good morning. This is Bloomberg Surveillance. Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
Big jobs report and a big reversal in Treasury yields, prompting a big rally in equities. Live from Studio 2 at Bloomberg headquarters here in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. Kicking you off to the closing bell here in the U.S. You take a look at the equity market right now with about 2 hours to go. We're looking at a little bit of a rally. The S&P 500 had been lower for 3 straight days. Not the case on this Friday, up by 0.4% after that jobs report. The headline figure coming in below expectations. That seems to be sparking a little bit of a relief rally, both in stocks and in bonds. You can see big tech rallying as well. The NASDAQ 100 up 0.6%, had also been nursing 3 straight days of losses. You take a look at the bond market, and that's been where all the action is. We had seen a pretty violent rise in yields this week. You take a look at what's going on this Friday, though. 10-year Treasury yields off by about 11 basis points. So definitely a relief rally in that market. You take a look at the 2s10s curve. The re-steepening has been very dramatic this week, but today lower a little bit, but still nowhere near the depths that we've seen on that 2s10s curve.
Yeah, put a pin in that thought, Katie, because we're going to talk a lot about that today, but let's go back to some of the risk sentiment out there in markets, bolstered today by that drop that we've seen in yields, but the dispersion there is kind of mixed. Strong inflows into global equity funds with a strong tilt toward tech this week. That's according to the latest read of private clients over at Bank of America. However, that same data is showing strong inflows into bond funds and cash and strong outflows from consumer stocks. Strategist Michael Hartnett and his team saying clients on a net basis, they're shifting back to risk-off mode amid perceptions that an economic contraction still looms. Atlanta Fed President Raphael Bostic addressing this topic a little bit earlier today. A sit-down with David Weston, this on the heels of that monthly jobs report this morning. He says there is a clear, in his eyes, welcome slowdown in the economy right now, a downshift that's orderly enough to avert recession.
I've expected the economy to slow down in a fairly orderly way. And this number, the 187, comes in continuing that pace. But I'm comfortable. I'm not expecting this to be over in a short period of time.
The Atlanta Fed president there, Raphael Bostic, no relation, adding that the Fed is on a trajectory right now to get back to that 2% inflation target and can actually get there by holding rates at the current level for a long period of time. Katie Greifeld, I just got back from Birmingham, Alabama. All the talk on the streets of Birmingham right now is what the swaps market is pricing in for the next Fed move.
Well, there's not much to talk about because if you look at it right now, it seems like the market is only pricing in about 40% or so that we do get another hike. You can see right now the Fed funds upper bound is at 5.50. What's being priced in terms of the terminal rate, 5.58%. And that pricing really didn't change after that jobs report that we got today. So we'll see as we continue to hear from Fed speakers whether this moved the needle at all. Of course, we have another jobs report before we get to that September decision, not to mention some CPI releases as well. And because of that really no pricing movement, maybe that's why you've seen the short end really calm down relative to the long end. If you take a look at 10-year and 30-year Treasury yields right now, they're coming down a bit today, but we saw a really dramatic repricing over the past several days, currently hovering near the highest level since November, even with the big rally that we're seeing right now, Romaine, in the wake of that jobs report.
All right, we're going to talk a little bit more about that jobs report and economic conditions, but first some breaking news, this involving Alphabet and specifically Google, apparently going to to face a slimmed down antitrust suit over its search business. Now, this is according to reporting by Bloomberg, saying that a federal judge has thrown out some allegations by the state's attorneys generals who had brought this case here. This ruling was unsealed just a little while ago here, and we're now learning that while Google still faces this lawsuit, it will be much more scaled back than what was originally put out there. We're going to try to get you some details on this for a trial, of course, scheduled to start in a few weeks' time in mid-September. Meanwhile, we go back to the big story of the day, which was that monthly jobs report that we got this morning, 8:30 a.m. Washington time, a surprise to the downside. But for some, it's a welcome surprise, an orderly decline in economic conditions, one that at least some folks think might help us avert recession. Tiffany Wilding joining us right now, PIMCO's chief economist and managing director there. And looking through these numbers, Tiffany, I mean, with always that sort of asterisk by this, that in any other environment, 187,000 jobs created would actually be considered a relatively good report. Did you find a lot of good in this report?
Yeah, I mean, you're absolutely right. You know, 187 jobs, just taking a step back is where we were prior to the pandemic. You know, it's a pretty solid pace of job gains. You know, now, of course, everything's relative, you know, and coming down off of, you know, plus 700,000 job gains when we were really recovering from the pandemic, you know, this is actually down quite a bit. You know, I think when we look at, you know, just kind of the broader trends in the labor market, I think what stands out to us is a couple of things. The first is the labor market is slowing. You are seeing payroll growth that is slowing, and that should continue, you know, as we have just the broader economy, which is slowing. You know, I think the other thing, though, is that wage inflationary pressures, although they've come down, more recently they've kind of been stuck, according to average hourly earnings, which is the wage data that's reported with the labor market report. So I think the key question here is still, how much labor market softening do we really need to get in to get wages that are back down with more mandate, central bank mandate consistent levels? And unfortunately, this report didn't give us a lot of information on that.
Well, what do you make of some of the comments that we heard today? David Weston had a chance to catch up with the Atlanta Fed president as well as the Chicago Fed president. And both of them kind of saying the same thing here, though, that they're seeing the disinflation, but they're seeing it in a much more, I guess, orderly fashion that, at least in their eyes, they think maybe gets us to that soft landing, though I should point out they didn't use that phrase.
Yeah, well, so I think you have to be a little bit careful. So the way that we're thinking about this is that, you know, there are myriad factors post-pandemic that resulted in, you know, what we call a one-off price level adjustment. You know, whether they were fiscal factors, which were exacerbated by supply bottlenecks and factors, you know, but that adjustment has basically, we think that's more or less happened. So that means that basically inflation should be coming down as those pandemic-related effects fade. Now, there's another kind of underlying issue here, though, which is that wage inflation or wage levels have not caught up to that increase in price level since we've seen since the pandemic. So people, from a real basis, are still down relative to what they're. So they want to continue to catch up. And obviously, we're seeing this with the strikes that are coming out. You know, the UAW obviously just coming out with a pretty demanding list.
Yeah.
The United Auto Workers. You know, and so there's still, with tight labor markets, it looks like there's a bit of labor bargaining power out there. And so the question is, does that keep wages and wage inflation more sticky? In which case, you could have a situation where, you know, price level inflation starts to really moderate in the back half of this year, but eventually kind of accelerates back up because wages aren't moderating. Tiffany, I'm hoping you can solve a little bit of a mystery for me, because when we think about the data that we got this week, of course, we got ADP absolutely crushing it at about 325,000 jobs. And then you look at what we got from NFP, 187,000. And there's been a lot of talk about how there's usually a disconnect between those two data sets. Feels particularly pronounced in this last month. How do you think about the relationship between those two numbers? Yeah, I mean, I think that the ADP numbers, quite frankly, are really, really hard to interpret. You know, we look at other data from a company called Paychex, which looks, you know, they have a sample of small companies that they service, you know, and the data that's coming out of their database is suggesting also opposite trends as to what we saw in the ADP report for small businesses. You know, it basically suggested that some of the reacceleration in ADP payrolls was small and mid-sized businesses within the leisure and hospitality sector, in particular like areas in New York, where these other data sources, effectively are putting small businesses on a pretty decent downward trend. So it's really hard to read the ADP data. In general, we really try to focus on the NFP data, and I think there, again, what the story that comes out of that, is that you are seeing labor market slowing. Now, I don't want to get too wonky, but there are other things, other kind of source data that the government uses that actually suggests that payrolls actually might be overstating what's actually happening in the economy. So, if you look at, on a lag, if you look at unemployment insurance records and things like that, it suggests maybe the labor markets aren't as hot as what the labor market report suggests. Tiffany, I'm hearing what you're saying, and it sounds like I can ignore ADP going forward, so I like that. We don't have much time left, but I do want to push ahead to next week when we do get the July inflation numbers. And if you look at CPI, what's expected on a year-over-year basis, expected to see a little bit of a reacceleration from 3% to 3.3%. I know a lot of that comes back to base effects, but is that a dynamic you expect to see continued reacceleration? Well, as I said before, I do think you will see in the year-over-year rates, I think core is the one that everybody should really focus on here because, as you said, we had a lot of volatility in energy prices last year, and that's resulting in volatility in how the year-over-year rate moves now because those prints are falling out of the calculation window. But core, you don't have as much noise, so really focus on core here, and we do think core inflation can decelerate down. CPI core inflation can decelerate down to 3 or 3.5 by the end of this year. Yeah. Now, but again, some of the things that are causing that, they're a little bit one-off in the sense that you are having used car prices that are falling now. They're falling pretty fast, but that's not going to happen forever. At some point, used car prices will stop falling, and that downward pressure on core inflation will subside. So, we do think you can see some reacceleration in core inflation next year. But again, and that's going to depend on wage inflation, but that's a next year story.
All right, Tiffany, always great to catch up with you. Have a wonderful weekend. PIMCO's economist Tiffany Wilding there helping to kick off today's program here. A lot more coming up, including a discussion about economic conditions with Glenn Humbert, of course, a former Council of Economic Advisors chair, and Mark Duggan, who also served on that council under President Obama.
Plus, we'll talk with the CEO of freight transportation company XPO as the company's latest adjusted earnings beat estimates and overall soft environment for the sector.
And more pain for Carl Icahn. Shares of Icahn Enterprises having their worst day on record after the company slashes its quarterly payouts in half. Icahn blaming Hindenburg for the latest struggles. A conversation and so much more coming up in a bit. This is Bloomberg.
Replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but XPeng is XPeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Well, shares of two of the S&P 500's biggest companies, we're talking about Apple and Amazon, they're moving in opposite directions today after delivering their latest results. Abigail Doolittle has the latest.
Yeah, Katie, a tale of two earnings stories here with Amazon soaring, Apple down sharply, the worst day for Apple since January of this year, and on the week, the worst week since November of last year. So Amazon, of course, beat and raise. The outlook is rosy in terms of growth. Apple, the fourth quarter of down of a decline for sales. Let's take a look at that, in fact, because you can see here it's actually going in the right direction. The declines are becoming smaller, and it's estimated in the September quarter to become even smaller. December, if the iPhone sales cycle can kick in, we could be looking at growth, but that's a big if, because they're talking about the idea that there's less demand for these smartphones. As for the year, now this is a pretty busy chart, but the point that it's making is if we play it forward to NVIDIA up 209%, Meta doing quite well after its earnings report, 11% growth. Here's the rest of the pack. Amazon trying to join these two high flyers, Romaine, but clearly lots of pressure on NVIDIA. Will it go the way of Amazon or Apple? Well, we'll find it out toward the closer to the end of the month.
All right, well, let's get some perspective out of our next guest, Kara Murphy, joining us right now, CIO over at Kestra Investment Management. And actually, let's just start there, Kara, because we talk about this idea of just how dominant those big tech stocks have been, that magnificent seven, if you will. And a lot of questions, not so much just about how expensive those stocks gotten, but do you think people are actually willing and able to buy anything other than those seven stocks?
Well, at some point, I hope so, because there's only so much money that can go into just a very small handful of stocks. And if you think back to the beginning of the year, I mean, there was this really like gush of momentum into those names. As number one, the economy was stronger than expected. We had excitement over AI. We had evidence that technology, the sector in general, earnings were bottoming in the first quarter. So there were some good, really fundamental reasons to kind of pour money into those names. But from here, in order to have a really healthy rebound in the market, you have to have them share the love a little bit. And that's our bet from here. The market's at a bit of a fork in the road. We have to decide, do we just keep playing that same old tune and pouring money into those names, or do we see this rally really broaden out? And we think, you know, with it looks like corporate earnings are likely to bottom in the second half. Yeah. You know, we think that the Fed is close to the end. So again, there are a lot of reasons to start to be a little bit more fundamentally optimistic about the rest of the market.
And we should point out, just for our viewers, the Russell 2000, the small cap index, actually outperforming the S&P for a fourth straight week here, Kara, although we should point out they are down on the week. But that outperformance seems to be indicative of a shift in sentiment that we've seen over the last few weeks, where people, I guess, have a little bit more confidence about the economy, and as a result, some of those cyclical stocks and some of those small caps.
Absolutely. And in fact, the Russell 2000 started to outperform the NASDAQ at the end of May. It's kind of hard to remember that. A lot of people have glossed over that fact, but we now have a couple of months of the small cap starting to pick up that slack. And when you look at some of the valuation differentials between the smallest names in the market and the largest names, those have grown to wides that we haven't seen in quite some time. So you also have valuation support for those smaller names.
And from your perch as CIO, I'm curious to get your thoughts on the bond market right now, because it has been a wild week, particularly at the long end of the curve. When you think about some of the volatility that we've seen in 10-year, 30-year treasuries, how does that fit in how you're thinking about them in your portfolios?
So, I mean, think back to 2022, and I call that the existential crisis for bonds in general, where really, like, a lot of investors had left fixed income for dead. You know, now we have yields that are a little bit more, that are much more attractive than the beginning of 2022. You have a lot of the Fed rate tightening behind us. So there are a lot of those kind of fundamental things that are very supportive of the fixed income market. Now, you point the long end of the curve in particular has had an extraordinary amount of volatility, and that's where a lot of these questions about long-term growth and inflation of the U.S. economy and the creditworthiness of the U.S. government really come into play. And that's where the battle royale happens, at the long end of the market. So we're a little bit more comfortable playing the middle part of the curve, where it seems clear as the yield curve starts to sort of revert to a more normal shape and you have some pretty nice healthy yields. That feels like a more comfortable place to be than out in the middle of the battle on the long end of the curve.
Kara, we only have about 30 seconds left, but at what what point would you step into the long end? At what point has the sell-off gone on long enough?
I think as we start to get more clarity on terms of where inflation is going to be, so right now the bet is that inflation stays a little bit more sticky than where it is. So as we have more confidence that that's going to reliably kind of calm down, I think that becomes a little bit more attractive. And then also as we see the Fed really back off.
All right, Kara, have a great weekend. That is Kara Murphy. She is CIO over at Kestra Investment Management. Now coming up, we'll get insight on the freight shipping sector from the CEO of XPO as the company releases its latest results. That's next. This is Bloomberg.
Maybe I should go do something else. I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups that we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Right now at the supply chain, a look right now at the trucking industry. XPO out with results. The shares higher on the day for a second straight day. Shipment growth coming in the month of July at about 9% plus, and adjusted EBITDA for the full quarter topping expectations on Wall Street. Pleased to say that joining us right now for a conversation is the CEO of XPO, Mario Herrick. Mario, great to have you here on the program. Let's talk a little bit about the results in the most recent quarter and what actually drove that growth. Where is that growth coming from?
First, Romain, thanks so much for having me on. We reported a solid second quarter here, and the results we just posted this morning, where we beat expectations on EPS, we beat expectations on EBITDA as well, and margin expansion in our less than truckload business here in North America. Now, importantly, we grew our shipment count 2% in the quarter in a backdrop of an industry where shipments were down in the high single-digit range across the industry. Now, the reason why we're gaining those market shares, they are driven by improvements that we are doing in the service quality that we're offering our customers. And it's across multiple segments is where we're seeing those wins coming in.
I know that this probably isn't going to have been reflected in the second quarter earnings, but as you know, one of your competitors in the less than truckload business, Yellow, effectively shut down. Have you seen any sort of material increase in business as a result of that?
First, my thoughts go to everybody who has been impacted by the issues at that competitor. When we look at the quarter, as you said, the second quarter was not impacted by it, but we've seen that impact here in the month of July. With that disruption happening, we've seen a big uptick in demand with freight going to other carriers. Historically, the less than truckload industry has been tight on capacity. There's not enough trucking terminals or service centers in the industry to handle the volume volume. And when you have 10% of that capacity that has gone out of the market, we've seen that get distributed. And for us specifically, we've seen a big acceleration in volumes. Our shipment count was up 9% in the month of July, and we would see that demand to continue to be strong here as we head into the third quarter, given the industry disruption.
Would you expect to have to raise prices given that capacity is a little tough here?
Yeah, we do expect that. I mean, our customers understand that when you take out 10% of the capacity, it's going to cost carriers more to be able to move the shipments. And we always want to charge a fair price for the service that we are offering. And our service product over the last couple of years has improved tremendously. And our customers see value in that service that we offer, and then paying a higher price for it is something that they accept with us. We do see that the pricing in the industry, though, is going to firm up, given the fact that you have taken out 10% of the capacity, which was already, again, a tight industry when it comes to capacity.
So like you say, customers understand the dynamics here. Are you able to quantify, though, how much you might have to raise prices coming out of this?
Yeah, so we have seen an acceleration, and we call it yield or revenue per hundredweight of freight that we are moving. We have seen an acceleration of our pricing in the second quarter to begin with, and that we expect that to further accelerate here in the third quarter and fourth quarter. Now, the magnitude of it will depend. Usually in our industry, in a soft macroeconomic environment, we see pricing improve in the low single digit on a year-over-year basis. And in a tight market environment, we see that being more in the high single digit on a year-on-year basis. And we expect here with this industry disruption to see a move from the low to mid-single digit price increases on a year-on-year basis to head more towards the high single digit territory.
All right, Mario, going to have to leave it there. Appreciate you taking time for us. Mario Herrick there, he's XPO's CEO there. A look here at the trucking industry. Those shares higher for a second day here on a Friday afternoon where markets across the board are higher, at least for one day, not necessarily enough to compensate for the losses that we saw in the previous 3 days. And actually, I just need to correct myself here, Katie. Actually, since the show started, we've actually slipped into the red here, seeing a pretty significant drawdown actually coming across the board here. Keep in mind, most of the indices here in the U.S. were up with roughly about a half a percentage point or so here, but over the last 20 minutes or so now, dipping into the red.
Yeah, pretty dramatic. You look at the S&P 500 flipping into the red, down 0.2%. Had been higher by as much as 0.9%. Could be interesting to try to figure out what led it there. But you look at the biggest points contributor to the downside remain. Probably no surprise that it's Apple. Shares currently off 4%.
Stick with us. We're going to get you some answers here on the big market moves as we count you down to the close. This is Bloomberg.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can
spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Markets to close, almost 2:30 here in New York. An eye on the broader market and an eye on commodities as we close out the week right now with crude oil up for a 6th straight week. Abigail Doolittle standing by with our commodities close.
Yeah, indeed, Romaine. We have crude oil higher, but we have other commodities higher too, really in contrast to what stocks are doing today and on the week, although on the week commodities down despite the rally for crude oil. Today up 1.5%, and of course the strength having a lot to do with the inventory number that came out on Wednesday, plus the Saudis and Russia extending their cuts. Gold up ever so slightly. We do have the Bloomberg Dollar Index down about 0.4% today. That's going to help out commodities, just provide a tailwind. Wheat snapping a long losing streak today, up 1.3%, and orange juice up 0.7%. It's not entirely clear what's behind that strength. Earlier today had been up more than 1%. Let's just take a quick look at wheat, because into yesterday we did have wheat down 7 days in a row. Again, today higher, but net over that time period down 16%. Romaine, this is one of the worst losing streaks that we've seen for wheat for some time. There are some reasons to think it could decline more. A lot of this having to do with the idea that there could be more supply out there from Ukraine than had been previously thought.
All right, Abigail Doolittle there was a nice roundup of what's going on in the commodities space. Let's turn back to equities and a look at Icon Enterprises, IEP, down 26% or so here on the day, having its worst day on record, a stock that's been battered around for quite some time. This after the short seller Hindenburg accused Icon and the company's practice of Ponzi-like behavior. Crystal C joining us right now to talk a little bit more about that. The market moved today, not necessarily because of that report, but more importantly, I guess, the reaction to the fallout from that report, a big cut in the dividend.
That's right. They're cutting dividend by 50%. It's now $1 per unit rather than $2 per unit. Icon had always give out a dividend, so for him to signal that it's coming down gave the market a sense that he's giving in to the Hindenburg report, and Hindenburg actually responded on Twitter, or X as we call it now, that they have predicted this in May that that will happen.
And that's what's interesting here, because of course Icon has vehemently pushed back against the report, but the dividend was part of it. It was one of the key characteristics of that report.
Yeah, so there are a couple of criticism in the Hindenburg report, and Icon so-called enriching himself through these dividends is one of the criticism. And some of the other things include how the net asset value of IEP, which has mostly public company equity holdings, is also another question. So this interesting, move for him to draw down the report also follow another move where he pegged his personal loan against assets.
But that seemed to be the crux of the report, as well as some other criticisms of IEP. I mean, there are a lot of people that were kind of wondering why this is even a public company. But it's very clear that a lot of this was a way, effectively, to provide payouts for himself and for the people affiliated with the company, which is perfectly legal. But it raised a lot of questions about, I guess, ethics, if you will, to put it mildly here. Does this resolve that?
So the payout, like you said, Carl Icahn himself is the majority owner of IEP public holding. So whenever he gives out a payout, he's
Yeah.
getting majority of it.
That's nice.
And so it's a corporate governance issues for sure. And as an activist himself, he's really always attacking companies with corporate governance issues. So this is when Icon get Icon, where Hindenburg is calling him out using some of his own tactics.
You said he got iconed.
He got iconed.
Okay. You should trademark that.
Yeah, well, we heard from Carl Icahn, of course, in that letter saying that they're going to stick to our knitting. What exactly is that knitting?
So he has said that activism is the most important strategy in IEP. He's going to go back to his roots, focus on activism. Not that he's ever left. If you remember, he had a very interesting board fight with Illumina, which resulted in him winning one board seat. So he's saying that he may be tweaking some of the short strategies, but his long strategy remains the same, and he will still be an activist.
Okay, it'll be interesting. But a real activist, not just like picking fights with his rivals and other people like that, like actually fundamental activism.
Well, he's not gone away, so we'll see.
I mean, this was all the talk in Birmingham.
This was all the talk, yeah. Not going away. It's going to be fascinating to watch. I'm sure you'll be all over that. Our thanks to Bloomberg's Crystal C. Still ahead, it's been one downgrade after another for Southwest after posting weak results last week. Jefferies, just the latest to cut its rating on the stock. We'll talk to that analyst next. This is Bloomberg.
The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rate World Cup. This is a 3.
As the economic picture does.
The OK is getting ready to make a decision.
Most of the large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Three prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. Let's start with Amazon. Rosenblatt lifting the stock to a buy. This after the company reported second quarter results that beat expectations across the board. The analysts there saying that Amazon's move to focus on retail and AI for its cloud computing unit opens the door to higher multiple consumer growth stories. Shares having a phenomenal day, up 9%. Let's take a look at Shake Shack, getting an upgrade today as well. This to outperform over at Raymond James. The analyst citing, well, Shake Shack's second quarter results and says annual unit growth of more than 20%. Not only could that create significant shareholder value, but it will do so particularly if they can use that as a way to boost margins. Shake Shack up 5% on the day. Meanwhile, CSX not having a great day at all. Cut to neutral over at Bank of America, the firm's first neutral rating on the transport company since 2016. A lot of concerns right now about the railroad's performance, particularly following the exit of its COO and then the appointment of a new CEO that's really being heralded over at rival Union Pacific. CSX down 4% on the day, and those are our top calls. We're going to stay in the sell side space right now and take a look at Southwest. There was a downgrade there just a little while ago in the wake of weak earnings results. Jefferies analyst Sheila Kahyaoglu cut her rating for the budget airline to underperform from hold. She also trimmed her price target down to $25. Sheila joins us right now to talk a little bit more about what's ailing some of these airlines, Sheila. And is this all about domestic travel right now?
Yeah, thanks so much, Romaine. I do think it's about domestic travel slowing down, and that's one takeaway from earnings. We got to see the big network carriers report earnings like Delta, United, and they were really good. And that was on their international offering and premium offering, which are over 50% of sales. And then as we got to see Southwest and the low-cost carriers report, we saw a softening in the U.S. consumer become more apparent, and that's why we decided to cut our rating to an underperform. It's the only underperform on the street, and we're about 40% below consensus for 2024 numbers.
Is there a cost story here, Sheila? I mean, if you assume that there might be some material weakness in bookings and maybe even pricing, is there a cost story there that that Southwest can actually sort of turn to preserve some sort of value?
Not only are we negative on the revenues, which we could get to, but on the cost side, management discussed about $1 billion of cost savings as the fleet was the capacity was optimized this year. Now they're talking about $500 million of net savings from the network being optimized next year. That starts in Q2 of 2024. However, Southwest has to restructure its network a bit because post-COVID, their network isn't as aligned to customer needs, and that's where they're seeing the most softening of pricing. So that's the cost element that they're talking about, but we just don't believe it just yet because clearly they have to reorganize their network a bit. And at the same time, they cut numbers on 2023 for higher costs because they're seeing higher labor accruals. So obviously salaries are going up for pilots, and of course jet fuel, as we just discussed, is also up.
And Sheila, to your point that, you know, when it comes to these domestic airlines, maybe the U.S. consumer weakening a little bit, that would hurt the likes of Southwest. What would that mean for an American, for example, which also really relies on the domestic market?
We think it's going to, the most immune to this will be Delta and probably United, just given their international exposure. Based on JetBlue's commentary, you could see some softness at American as well. But primarily, Southwest is sort of stuck in the middle. Because they're between the low-cost carriers and the network carriers, they're getting squeezed the most. Additionally, while pricing is going down, Southwest is adding capacity. So we expect them to add about 8% capacity. They're taking 70 Boeing 737 MAXs this year, another 100 next year. So in Q1 of 2024, their capacity, their flight schedules are increasing about 14 to 16%. So that's not helping them either. So they have that fleet dynamic, and also the low-cost carriers are adding more capacity at the same time.
Adding more capacity. Do you expect those decisions maybe to be reversed at this stage if this dynamic, this backdrop continues?
I think it'll be hard for airlines to step away from aircraft that they're expected to receive in, the next 6 months to a year. They're contractual, so that's unlikely. And they actually exercised options this quarter, so I don't think so. They'll probably look to optimize the fleet. And the good news for Boeing and the rest of the aerospace supply chain is Other carriers we're hearing from are not necessarily talking about price declines. And, you know, if you listen to Lufthansa yesterday, they saw pricing up, yields up 25%. So they're seeing, you know, good stuff in Europe over there. So I think with Southwest, with the fleet, they might have to rejigger it a little bit, but for the near-term aircraft that they're slated to receive, they're like unlikely to get out of those.
I want to end here, Sheila, with the question just about the strategy that Southwest is taking. I mean, we sort of think of them as a discount carrier, and for years we know that there was a certain simplicity to their business model that I think endeared a lot of customers to them. But anyone that's flown Southwest over the last few years knows that they're nickel and diming customers the same way that the other airlines are, in fairness here. Do you see any sort of chance that maybe they will try to differentiate themselves in a different, in some way, rather than just going down the same road that the other airlines have taken?
I mean, they still have good customer service aside from the blips we've seen over the last year, but the issue is really their network, and they've kind of gone too big. So where they're adding capacity is the 300th flight out of you know, Denver or Baltimore isn't really helping them and is hurting their price. And as we talked about, like the dynamics of where the work from home is post-pandemic has changed and has really hurt their network. So it's not so much about the customer and the brand, although people think that given their recent issues. We think it's more about the network.
All right, it's great to talk to you, Sheila. Have a wonderful weekend. Sheila there, Jefferies analyst covering the airline sector. A look at Southwest Airlines. Meanwhile, some breaking news back in the trucking sector. This involving Yellow, the company, of course, that is set to go through bankruptcy. Learning through that bankruptcy filing that it is mulling an asset sale here. We don't have a lot of details here about exactly what exactly will be sold here, but we do know that this Chapter 11 process for the company could actually lead to some degree of liquidation. So a lot of discussions right now about the removal of a big player in the less than truckload market, whether that benefits companies like XPO and, more importantly, where those assets end up. All right, meanwhile, we do want to go back to the broader economy here, because discussion coming up after the break between two major players in economic policy. David Weston out at the Aspen Economic Strategy Group, a sit down with Glenn Hubbard, who used to head the Council of Economic Advisors under President Bush, and Mark Duggan, who actually served on the Council of Economic Advisors under President Obama. That conversation coming up after the break. This is Bloomberg.
Replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation? Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
Time now for our Wall Street Week Daily segment with the host of Wall Street Week, David Weston, on location at the Aspen Economic Forum, sitting down right now, a conversation with two key players in economic policy. David.
Yes, Romaine, we're back in Aspen, Colorado right now, and the subject this year has been building a more resilient U.S. economy. You can't do that without talking about the debt and the deficit. You can't talk about that without talking about where we are with Social Security. So we're delighted to be joined by now an expert on that subject. He's a professor of economics at Stanford. He's Mark Duggan, and also a regular guest of ours, I'm delighted to say, is here. He is Glenn Hubbard. He's from the Columbia Business School, where he was the dean for many years. Before that, he ran the Council of Economic Advisors for President George W. Bush. So, gentlemen, thanks so much for being here. Mark, I'll start with you because you're really working on this project.
Right.
You're going to have a paper coming out in the fall. Tell us what the problem is from your perspective on Social Security right now.
Right. Well, Social Security is America's largest and most important government program. It provides benefits to 1 in 5 Americans, and right now it's starting to run a deficit that is growing each year, and it is drawing down a trust fund that if policymakers don't act in a pretty aggressive way in the near future, all Social Security recipients will face an immediate 23% cut in their benefits, which would have huge economic impacts.
When does that come?
2033, so 10 years from right now.
So 10 years from now. And is there any alternative? Is there any other alternative to really cutting people 23%?
Yeah, if there are changes made to the program before 2033, then we can avoid that large benefit cut. But those changes need to happen sooner rather than later.
Normally in business, the way you address something like that is both by raising revenue and cutting costs. Is that possible here?
That's pretty much what needs to be done. There's no way to pull a rabbit out of a hat with this, and there's a combination of ways, either increasing revenues to the program or reducing the growth rate of benefits for the program.
So, Glenn, you've been studying this, following it for many, many years. What is the right approach, and why haven't we taken it?
Well, I think Mark's right. If we want to make changes in Social Security, we do have to get incremental revenue and cut costs. But I would widen it. I fear another door politicians will reach for is just using general revenues. That is not covering the deficit and adding further to our problems. I think what we need to do is almost like the Greenspan Commission, form another commission to tell the public what this is, what the trade-offs are, and then make changes to the program that modernize it. Maybe we need to raise minimum benefits. Maybe we need to make the affluent get a little bit less generous treatment from Social Security. Mark teed up a lot of this in his important work, and I think we've got to get on this. But communication with the public is essential.
Well, the Greenspan Commission, I think got around some of the politics of it, right?
Absolutely.
Explain exactly how that worked and why it let some of the politicians off the hook, if I can put it that way.
Right. No, it's fair to say, fair to put it that way. It was 40 years ago, and it was a bipartisan compromise, and it was a little bit messy, and it was unclear up until the 11th hour if it would actually happen. But it was a combination of a gradual increase in the tax rate for the program from 10.6% to 12.4%, and an increase in the full retirement age that was phased in only gradually. So there was no change in benefits for existing Social Security recipients, and there was no reduction in the growth rate of benefits for anyone for another 15, 20 years. So it gave people plenty of time to prepare, and ultimately that was a reform that lengthened the life of the Social Security program. But here we are 40 years later, and we've got to come back to it now.
So, Glenn, one of the problems, as I understand it, is we've pretty much, since that 40 years ago, kept the rate of the taxation basically where it is. Even as incomes went up, you only pay up to a certain level, right, of your FICA tax, and then it cuts out.
Well, that's right. And I think Mark's paper proposes ways to get at that, either incremental increases in the payroll tax rate, changes in the payroll tax base, or a supplemental tax perhaps on high earners. But, a couple of things have changed in these 40 years. One is the scope of demographics. We now, it used to be 40 years ago, you can say, well, we're not going to touch the retired or nearly retired. Well, that's a little bit harder to do now. And our politics are much uglier. The kind of commission approach is going to have to be really artful.
Yeah, one of the things that your work has pointed out, Mark, actually, is the benefits have actually increased in the sense that we live a lot longer.
Yes,
so the total amount of money that we get is actually a lot more than it was 40, 50 years ago.
Much, much, much greater. Yeah, our life expectancies since those amendments 40 years ago have grown very significantly. And so the effective value of Social Security to today's taxpayer, today's worker, is much greater than it was then.
Glenn, also strikes me that one of the issues here is the money, there's only so much money to go around, presumably. And And if you're spending it on Social Security and things, you're not spending on maybe some other social programs that we need to do for the country.
Well, and this is why I think a commission is going to be important. It's no doubt we need to spend more on national defense. I think both parties are in agreement on that. We want to make further investments in preparing workers for the modern economy. We have infrastructure needs. We have all of these things. We have health care. We really have to talk about trade-offs and costs, because I think we can't raise taxes enough to cover all of the financing needs of our social insurance.
So, Mark, you spent time in Washington. You have some sense of the practicality. Even in the work you're doing, you're trying to make it practical. You're not trying to be too radical. Are you getting much uptake on some of the things you're talking about? Are policymakers in Washington at least open to talking about this?
I think they are open to talking about it, and they recognize that this is a really important issue, and they can't kick the can down the road for much longer. So I think that there's a conversation, and everyone has their preferred approach, but there's no simple, easy way to do it. And I think getting people to the table, talking about potential compromises, is something we can do. I hear a lot of concern that things are too polarized and things are not in D.C. as friendly now as they were 40 years ago, but I believe that in this country we can come together and solve this challenge.
Glenn, give us some hope here, because some of us outside of Washington feel like Washington doesn't do anything hard until they have no other choice.